Welcome to Access a Trader, the #1 community for those who are committed to taking control of their trading in order to achieve success, profitability, and longevity. Thank you for joining us. Here's Dan Shapiro to help you find your edge, master your process, and own your future.
All right, cool. Just like always, guys, do me a favor, just click on the channel, make sure everybody can hear me. More important, see the screen. All right, cool. Thank you. Anyway, guys, thank you very much for your dedication, right? Thank you very much for your dedication. Thank you very much for spending a couple hours. Okay, a couple hours discussing the same things we talk about throughout the week. And thank you very much for all you new folks. Thank you very much for all you new folks who are joining us. Obviously, you are at the stage of your career, whether it's year 1, year 3, year 5, or maybe somewhere above that you've been kind of trying to navigate the markets in your first couple of years. Obviously, very, very difficult. More chances than not that you are pretty much trading the same way as social media is trading, right? The hot stock of the day, 1-minute candles, the same nonsense with the dark pools and the market makers and all that nonsense. And you guys are being raised on just bad information. It's just really just reality, right? Most of you guys, the only exposure you have is the social media, and everybody trades exactly the same way, trades exactly the same stock, trades at exactly the same time, and they get exactly the same results. And I've always said throughout my years, and again, I've been hosting this webinar for 16 years, and I've been always saying, I go, if you trade with retail, expect to get retail results. If you trade random stocks, well, you expect to get random results. And unfortunately, because your ability is to only get information from social media, you're probably getting information from people that are my son's age. My son is turning 18 in August, and they glamorize this business, and they put you in a situation to believe that if you don't understand and if it doesn't all click within the first 6 months of your journey, it's a failure, and you will never succeed in this business. Some of that is true, right? Some of that is true, because realistically, if I sit here all day, right, all day in your first 3 years, and all I tell you is 1 + 1 = 6, 1 + 1 = 6, 1 + 1 = 6, well, guess what? You are going to develop understanding that 1 + 1 = 6. And that is the problem. For all you guys who know me, a lot of you guys are obviously have been with me in the webinar for a long time. That's why I'm very surprised some of you guys are here. Shame on you. Go do something else. But the reality is, this is a very unique process. Nobody else on the planet, for the exception of us, trades this way. Okay. You cannot go on YouTube and figure this out, because nobody else trades this way. And this is why people talk about an edge in the market, an edge in the market, an edge in the market. And I've always made it pretty clear that it's so much harder, right? So much harder getting the edited version of what happens throughout the day. That's why I always maintain the idea of, guys, come into the webinar first, see how it plays out in real time, and then off hours, right? Watch the PS60 theory, the first one, PS60 theory, the second one, and everything else in between, because the point is you have to see it first and let your brain digest everything, and then start to understand. So a lot of you guys are going to be here, who are here for the first time. None of this is going to make sense to you. Okay. If you have never watched the workshops, if you've never been in here, I'm pretty confident to say none of this is going to make sense in the next 2 hours, because you've never seen it, right? Nobody's ever showed this before. But again, don't be discouraged. That's the whole point. When you haven't seen something and somebody tries to explain something to you for the first time, it's like seeing a UFO. It's like me trying to explain to you what the wind looks like, right? We all know what the wind feels like, but how can you explain to somebody what the wind looks like? So don't be discouraged. I'm going to say a lot of things today that you're probably not going to get. Most of the stuff you will, but a lot of the stuff you won't get, but that's okay. That's the point of you attending the webinar, right? Monday through Friday, and you're seeing everything play out. So when we talk about a potential rejection, right? Rejection today, you're going to be like, what the hell's a rejection? Until you see it Monday and you're like, that's what he taught. I got it now. Okay. So don't be discouraged. Take a deep breath. You don't need to figure it out all in the first 5 minutes, in the first 2 hours. That's the whole point of understanding and having your learning curve take its time to kind of play out, because everybody's different, guys. Always remember that. I've seen people get this from the first 2 weeks. I've seen people finally click for the first 2 years. And I've seen people who've never gotten it. And that's okay, right? That's okay. Everybody develops it. Okay. I've always maintained the idea that I don't personally believe that pivots are for everybody. I just don't. I think if you have a $500 account or you have a $2,000 account or a $1,000 account, it's probably not going to be for you, right? But at the same time is you're adapting the principle. You're not adapting the stocks that I personally trade, but you're adapting the principles. So how we're going to do it is we're kind of going to reverse engineer this, right? All you guys, I'd say 99% of you guys have attended the workshop for at least a week. Okay. Some of you guys have been with me for 14, 15, 16 years. So you kind of get everything. But this is what I wanted to do was kind of a refresher, right? This isn't like, it's like the iPhone, when they come out with the iPhone 27 every 2 weeks, they don't overhaul what they do. They just make cute little adjustments, right? They make cute little adjustments and they add on little features to make the overall product be better. And that's exactly what we did. Last time we recorded a webinar was before COVID, right? That was before COVID. That was the PS60 Theory Part 2. Okay, so that was the last time. So a lot of things have changed since before COVID. Okay, and we added more supply and demand zones. And somebody could turn around and say, at some point, Dan, we're not going to have any room to put on a trade. We always laugh, but hey, those supply and demand zones are there for a reason, and we'll get to that in a second. So how I want to attack today is for the first 20 minutes or so, I want to just kind of break down bare bones the PS60 theory. Okay, bare bones of the PS60 theory. For all you guys who are here for the first time, I would really suggest that today, and it may go after the next couple of weeks, watch the full version of the PS60 theory. It's like 4 or 5 hours. Watch point 2 of it's also like 4 or 5 hours. So I just want to go through the bare bones in the first 20 minutes, and then it will start, and then we'll dive into what we found in the last 3 to 4 years have been an incredible advantage for us, which is using the options flow, the correlation with pivots, and obviously, especially what we started really doing very, very well in the last 2 years is the rejections and the bounces. All right, so that's that. So welcome to the PS60 theory. So what the hell is the PS60 theory? I already kind of forgot. So if you guys go on like ChatGPT or Gronk, it'll give you a better example. But what the PS60 theory basically is the idea that stocks trade from supply to supply and demand to demand. What is supply? What is demand? This is basically all these weird little things, all these weird lines that you hear sometimes people on the recorded videos, like on the nightly videos on YouTube. So I'm like, hey, why, Dan, how come you have all these stupid lines? And I laugh and I go, no reason. These stupid lines are your lifeline. This is where your ability is to understand where emotional buyers meet technical sellers, that is supply, and emotional sellers meeting technical buyers, that is demand. And every single line here, right? Every single line here represents an area, a history of the stock where price action was discovered. These are not just random prices. At one point or another, okay, this stock had some sort of war, some sort of battle. Maybe I shouldn't be saying that in this time, and this is the time of the Iran, now, Israel, now U.S. War. But that's kind of it. It's the battlefront. It's price discovery. So all these lines, when you're a brand new trader that you deemed unnecessary, all of us can pretty much testify. We could put our hands on the Bible and say, yeah, they're pretty necessary, right? This is where price discovery comes at some point or another. Sometimes, and this is the coolest part about pivots and supply and demand, sometimes these stocks stop literally to the penny, right? We've seen that so many times. We're like, holy crap, this thing literally stopped to the penny. And sometimes they overshoot. And again, we'll kind of get to that overshooting part when we cover the bounces and the rejections a little bit later. But the point is, all this is price discovery. All this is areas that you can make an educational, right? An educational decision, choice, that you believe where a stock should take off, where a stock should stop, and where a stock potentially could get rejected. And it's very, very important, because if you're trading without supply and demand zones, you are guessing, right, guys? You are guessing. It's like, I'll give you a perfect example. It's like all of us who were in CRWV on Friday, right? And we said, well, if we can get to 186, let's get down to 1 to 10% of our position. We didn't just pick 186 out of the sky, right? We didn't pick 186 out of the sky. We picked it because there was a supply zone, right? There was a supply zone right over here at 86. And the ironic part was, look at the high of the day, right, guys? Everybody remember? Look at the high of the day. 186 was literally the high of this channel here. And again, that really shows you how stocks trade from supply to supply and demand to demand. So now the question is, well, how do we take advantage of this, right? Dan, how do I make money with this? Isn't that the whole point? Yeah, it's cool and all that we could identify where stocks start, where they stop. But how do I take advantage of this? How do we do it, right? How do we put ourselves in the position that we're putting ourselves in a situation that we are trading or about to trade a stock that is not moving, but is tradable? And it's very, very important to understand. And that's kind of where this segue starts here, right? Guys, always understand this, okay? Every stock trades, right? Every stock moves. So when you hear somebody on social media talking about, well, this stock is moving, that stock is moving. Guys, the market's open, right? The market's open. Every single stock is going to move, okay? Tesla moves, Apple moves, hell, AMC moves, right? We only talk about the highest quality stocks in here, right? Every stock moves, but the problem is 99% of stocks are not tradable. And the problem is majority of traders, especially new traders, they don't understand that. They believe that every single stock, because the market is open, it's tradable. It's not. And let me break that down for you, okay? I trade pivots. 90% of my trades are pretty much the same 10 stocks, realistically. And then, then I'll go, through like the CRWVs of the world, like I traded on Friday, so forth and so on. But for me, 90% of my trades are going to be beta names. So Tesla, Apple, Amazon, Meta, Nvidia, the same, all the major lunatics. So if those stocks are not in play, I can't trade, or I have to put myself in a situation is I have to trade other things. Hence why I traded CRWV twice on Friday, because the majority of my stocks, all my stocks were not in play. And that's the problem. Every stock moves, but not every single stock is tradable. So what you need for a stock to be tradable, and this is kind of how we kick off the PS60 theory, is number one, you need a range, right? Now, what's a range? In my opinion, for a stock to be tradable, it needs to take out at least a week's worth of range. So that's at least 5 days. So if you look at, for example, I'm going to use this week's stocks that broke out of a range, and you're going to see there are no beta names, because we all know this whole week, beta were just kind of going sideways, just because everybody was, kind of sitting on the sidelines waiting to see how far and how much of a participation will the United States be involved in this whole fiasco in the Middle East. We obviously got our answer last night. So we're not going to use any beta names as examples this week, but we're going to use second and third tier names as an example. Remember, the PS60 theory, although I trade beta names, right? The high mega cap technology names, you can trade anything, right? As long as that anything is any asset class, you can trade Bitcoin, you can trade crypto, you can trade futures, right? You can trade small caps, you can trade mid caps, anything your heart desires. But here's the but, right? Here's the big but. The but is whatever asset class you trade, there has to have a lot of liquidity, right? So when you look at Bitcoin, for example, when you look at Tesla, for example, right? You need liquidity and you need a range, okay? You can't just randomly trade a $2 stock that's trading 18,000 shares today, right? You're not going to get anywhere. It's also, again, why are you trading a $2 stock that trades 18,000 shares? But that's a whole different conversation for another time. So number one, you can trade any single asset class, okay? So just because I trade Tesla doesn't mean you have to trade Tesla, okay? And it's a very, very important to understand that. So that is a very, very important part. So now the second thing is you need a range. So like I said, I like potentially at least a 5-day range for a stock to be not necessarily be a macro expansion, right? Expansion, potentially big move, but you need at least a 5-day range for it to get a little bit of juice. So let's use an example, for example, like we'll use DraftKings, right? Let's use DraftKings. I know some of you guys are still swinging it. So here is DraftKings, okay? As you guys remember how we talked about, again, stocks trade in channels, right? Stocks trade from supply to supply and demand to demand. And as you can see here, DraftKings has been underneath supply for a very, very long time, going all the way back to January, February, March, right? So to March 6th. So March 6th to all the way to June, there was all underneath supply, right? There was absolutely no room for the stock to go. Because remember, all these lines, quote unquote, air quote lines, they represent supply. So the longer a stock trades under supply, the stock can't go higher. It could go up, but it'll get rejected into supply. Again, for all you guys who are brand new, this is like watching like a UFO come in. Like you have no idea what I'm talking about, but it's okay. It's okay. You're going to see it live and it's going to register in your brain as soon as you see it play out live. But from the point of reference, just from the conversation point of view, does everybody see the high point here on DraftKings? It was on May the 12th and it hit the supply zone here, roughly around 38.85. Everybody see that, guys? This is the highest point of supply and then it got rejected again, right? It's pretty basic stuff. So here is your supply zone. It got rejected and went all the way down to here. Okay, so if you're trading DraftKings, you don't care about the stock, right? And any point underneath supply, right? Underneath supply is like the equivalent of you being drowned, right? Picture somebody's drowning somebody and they keep on pushing their head underneath the water and they try to pop up to get a air, right? Here's the stock trying to pop up to get some air and somebody's pushing their head down, right? Pushing their head down just to drown them again. This is why the stock goes down. So we don't care. I don't care what the symbol is. We don't care. Like, for example, I don't care that Tesla right now is at 322. I don't care. We'll get to Tesla in a second, okay? Right now, Tesla's underwater. I don't care about Tesla right now, right? So when you look at DraftKings, we didn't care about DraftKings till an area of the market, an area of the chart that the potential drowning victim could finally get their head above water. So let's talk about this, right? Let's talk about this. And this is when you see things visually, and sometimes when you see it visually, it starts to understand. So you had this big move. Let's start out all the way down here, right? So it lost the 50-day moving average. Obviously, the 50-day moving average below the 50-day is a sell signal. Above the 50-day is a buy signal, right? First basic thing. Also, guys, just write this down. This is the most bearish thing you can possibly have in trading. This has nothing to do about the PS60 theory. Write these two things down. Like I said a second ago, above the 50-day is bullish, risk on. Below the 50-day is bearish, risk off. Okay? That's the first thing. The second thing, and this is the most important thing of trading, and I still don't understand why so many people have a very hard time understanding this. Guys, write this down. A stock cannot go up. Impossible. A stock cannot go up if it doesn't take out the previous day's highs. Okay? A stock cannot go down unless it takes out the previous day's lows. Okay? Forget about the PS60 theory. That is the most basic thing of technical analysis. But for some reason, when a lot of times when people look at Tesla, they go, "Oh, Tesla's ripping," and I'm like, Tesla's ripping, but it's still $3 below yesterday's highs. How could it be ripping if it's below yesterday's highs? So it's a very, very basic. So before, and again, it has nothing to do with the PS60 theory, but before you put on a trade, right? Before you put on a trade, you have to understand that a stock will never, absolutely impossible to go higher if it doesn't take out a previous day's high. So if the previous day's high is $105, well, how can you possibly think the stock is bullish at 101? Right? It makes no sense. So it's very, very important. But the most important part is for a stock to finally go up, it needs to take out a range. So follow me on this. And this is kind of how we're going to visually make you understand the most basic thing of pivots. So it loses the 50-day moving average and starts a cycle, right? Starts the cycle down. Again, below the 50 days bearish. So the stock doesn't go straight down, right? Stock doesn't go straight down. It will bounce. So what happens? The stock bounces and it gets rejected as supply. It bounces again, gets rejected as supply, and it starts going down. Now it's taken down a whole big range of about a week and a half. And again, this becomes a natural pivot. And then the next leg starts to go down, 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 down. And then it starts to recover again. Again, remember, we don't care about the stock. I'm just showing you the nuances for what happens when the stock finally gets some life. So the stock keeps on getting rejected at supply and keeps on going lower, rejected at supply, goes lower, rejected supply, and goes lower. Now here where it gets interesting, right? So we all know below the 50-day is bearish, right? But now it comes to a point of the chart and so, well, wait a minute. It's about to reclaim back the 50-day moving average, even though it's not clean, right? Because again, you can see all these supply zones, all these trees in the forest. But the point is, now it's coming back to the 50-day moving average. Well, let's see what happens if it could reclaim the 50-day. So what happens, right? It gets rejected at the 50-day moving average on May the 8th. But what happens on May the 9th, right? May the 9th, it reclaims back the 50-day moving average. And again, all of a sudden, an automatic buy signal comes in. It doesn't mean the stock will break out, but it means that at least for that interval, at least for that daily interval, if it could get back above the 50-day moving average, at least it should give you a multi-day move. And that's literally exactly what happened here. So it took out the 50-day moving average and it went from basically confirmed 36.11 and traded all the way back to the top of supply at roughly 38.85. Now, why did it get rejected at supply? Well, because it's supply. That's the whole point. You have to know where your supply zone is. So if you guys see, and this is kind of visually what we talk about, stock trades from supply to supply, to demand, you can see it didn't go straight from 36.11 to 38.85. Look what happened here, right? Stock went from 36.11, okay? It paused initially at this supply, reclaimed this supply, got rejected back at this supply, and the next day, it reclaimed back supply and went into the next supply zone. And eventually the stock, again, started breaking down again, lost back the 50-day moving average, and then went from, again, 34 all the way down to 32. But the most important part is, and we're going to fast forward this a little bit, right? It reclaimed it back on June the 6th. And finally, after going, little by little, supply to supply, demand to demand, supply to supply, demand to demand, what happened was, and again, congratulations. I know a lot of you guys are still swinging DraftKings from the other day. But the point is, eventually, the stock finally became relevant, right? And the reason why it became relevant, as every drowning victim, or at least potential drowning victim fighting for their lives, as you can see here, their head finally got above water. Everybody see that, guys? There are no more supply zones. Everybody see this candle, guys, right? There's no more supply zones. Once it got back above the upper Bollinger Band and got back above this last supply zone on 512, there's all airspace. Everybody see that, guys? Right? Forget about what it did the next day. It was supposed to do that the next day, right? It was all airspace. So it took down 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21. Let's just call this almost nearly a month and a half worth of supply, right? It finally got above a month and a half worth of supply. It finally closed. It was the highest close in the whole formation. And guess where the next supply zone is, right? Guys, does everybody visually see where the next supply zone is? And guess where the stock stopped, right? The supply zone was 41.11. Look at the high from Friday. Guys, everybody see the high from Friday? Right? The high from Friday was 41, and the next supply zone was 41.11, right? Magic, right? Again, if you're brand new to this, you're like, I have no idea what this guy's talking about. Because guess what? Nobody trades this but us. That's the whole point, folks. That's our edge. No, that's the whole point of everybody on the other side of our trades. They don't understand this. That's how we eat. That's the whole point. People don't understand this. If you've never seen this for the first time, you're like, I don't get it. Yes, that's the point. We're betting that you don't get it. We're betting that you're on the other side of our trades. You don't get it. That's our edge. That's the whole point. So as you can see here, it finally got out of this range and went right to the next supply zone, right? There you go, Boris. Thank you very much for answering the question. And that leads to my next segue, right? Leads to my next segue. These are our supply zones, right? These are our supply zones. I'm going to give you guys, screenshot it, whatever the case may be. I just want to take a sip of coffee. So these are our supply zones, okay? The Bollinger Bands, the linear regression line, okay? The linear regression line, the 200-day moving average, the 10-day moving average, the 5-day moving average, the 150-day. We added, and this is the difference between in the last 5-6 years, but we added the 34-day EMA, we added the 65-day EMA, and we added the 89-day EMA, and we added, I believe, the 150-day EMA. If you want to go completely nuts, you can put SMA and EMA on all those. I believe I have the EMA and SMA on all those. The only ones that are EMA are the 34, the 65, and the 89. Okay. All the other ones are SMAs and EMAs. So these are all our supply zones. What hit on 41 was the linear regression line, right? This is a linear regression line. I adapted the linear regression line about 8-9 years ago. A buddy of mine introduced me to that. So the most important part, right? The most important part is understanding that stocks trade from supply to supply and demand to demand. So now what the stock needs to do to really go crazy, right? To really go crazy, guys, what does the stock need to do? It needs to close above the linear regression line. So any close above 41.11 will start a major breakout for the stock because, as you can see, right, where's the supply zones, right? Where are the supply zones? That's the point. That's the breakout, guys. There are no supply zones. So once the drowning victim, right, once the drowning victim gets back above all the supply, that's when you have free airspace, right? You have free airspace. So look for example, DDOG, right? Broke out this week, right? DDOG broke out this week. Again, we're not going to go through all the way here, but as you can see here, it got back above the 50-day moving average, gave a buy signal. But once it finally, right, once DDOG finally got back above the last supply zone, which is its drowning victim, right? The drowning victim, he keeps on pushing you under. Look what happened. It finally got above, right, 123.77, and now it's in the middle of its breakout, right? 123.77 was the top of this range, was a 2-week consolidation, and now it's all airspace. Can anybody tell me where the next supply zone for the stock is? Assuming we don't go to war and the market crashes, right? But technically on the surface, let's just take all the wars and everything out of the equation. There you go. Does everybody see why 34.88 is the next target for the stock? So if you're swinging the stock, does everybody see why 34.88 is the next target for the stock, right? That's the linear regression line, correct? That's the linear regression line. So stocks trade from supply to demand, right? Trade from supply to supply. So it broke out here, right? You would take the swing above this 124 level, right? Above 124. The stock is in the middle of its breakout right now. It traded up to all the way up to 131.70s. And again, let's just say the market doesn't get destroyed by our participation in the war, right? It should ultimately, right? It should ultimately get back above and test this 134.88 level, right? Let's just use one more example and then we'll kind of dive into other things, okay? So look at Tesla, right? Let's look at Tesla. So if you guys remember, Tesla was doing absolutely nothing. Ricken, we'll get to that in a second. I'll answer that in a second. We'll take questions on this in a second. So here's the last example. You guys will kind of figure everything out. If you guys remember, January, February, March. In March to April, Tesla did absolutely nothing. You guys remember that? And we were like, damn, is this stock ever going to break out? The rest of the market's going nuts. Is this thing going to ever break out? And you can see the common denominator, right? It hits supply, it goes down. It hits supply, it goes down. It hits supply, it goes down. Finally gets back above the 50-day moving average, but then it keeps on hitting supply, right? Hit supply, goes down. Hit supply, goes down. And at one point, we were like, is this thing ever going to break out, right? Is this thing ever going to break out? And slowly but surely, again, we don't care. We don't want to be long anywhere, right? We don't want to be long anywhere underneath daily supply. So the longer the stock went sideways, and this is now a distribution, well, it was back then, a distribution going from March the 27th, and slowly but surely, right? Still not breaking out. Finally, right? Finally, on May the 9th, okay, so you're talking about a distribution from 327 to May the 9th. It finally got about above this whole level, right? If you guys remember, this was, gave us 19 points in 12 hours, right? So it finally got above the 295 area, right? Look where it stopped initially. Does everybody see that where it stopped? Ricken, do you see where it stopped initially? Right? The next supply zone, right? Now, guys, remember, the next supply zone is not a brick wall. It's a temporary pause, right? It's for a stock to kind of gain its breath. It's like a marathon runner running 26 miles. It needs to take a breath. So just because Tesla broke out finally above the 295 level, and you can see why 295 was such a big deal, the April 28th high was 295. The April 29th high was 294.70s. 294.78 was the 5-2 high. So it finally got above the 295 and it traded to the next supply zone at 307. But what happened the next day, right? It got back above, just because it broke out, it got back above, right? And it traded to the next supply zone, which was roughly, 315, 317. And then the next day, it got back above the previous day's high of 322. And then the stock went bananas, right? So the longer, guys, always just remember, the longer a stock sits in a range, the higher probability, right? The higher probability it's going to really explode to the next channel. Again, if you watched the first, for some reason I just thought of it now, I haven't really thought about it this way in a long, long time. If you watch the first PS60 workshop, I made a very nearly damn-rated, X-rated version of what exactly happens, right? Picture you're in prison for 7 to 10 years. You haven't been with a woman for 7 to 10 years. And then all of a sudden you get out of prison and your girlfriend's been waiting for you for 7 years. And you're like, oh, I can't wait. The buildup. I can't wait. Oh my God, I can't wait. Remember, you haven't been with a woman for 7 to 10 years, right? This is your buildup, right? All this distribution is your buildup. Oh my God, I can't wait. Oh, you don't understand what I'm about to do to you. And then finally, when you see this person, you can't take it anymore. And you get the explosion, right? That's the whole point, guys. The longer a stock sits in a channel, the higher probability it's going to explode. Pun and no pun intended, right? For that damn inmate that's been serving for 7 to 10 years, the explosion is going to be pretty aggressive, right? And that's why when you come to present day, right? When you come into present day, right? We don't care about Tesla right now, right? We don't care. And this is a real life example. We don't care about Tesla right now. You know why we don't care about Tesla right now? Because it's sitting in a distribution cycle. Everybody see that, guys? Especially if you're new folks. Visually, you can see this, right? Visually, you can see this. I don't think you need, you don't need a lot of time with this explanation. Visually, you can see it, right? Tesla had a run and it stopped at 35.50. Everybody see that, guys? And for the next 1, 2, 3, 4, 5, 6, 7, right? Monday will be 8. We're damn near a 2-week distribution. So where do we need to be long Tesla? I want everybody guys, look at your charts. Look at your charts. Tell me what the June 11th high is. And guys, open up your charts and tell me what the June 11th high is. 35.50, right? Everybody see that? Especially if you're new folks. You see that, guys? 35.50, right? Everybody see it? 35.50. Okay. That is the highest level in this supply zone because it keeps on getting rejected at 35.50. So if you're an options trader or an equities trader, right, the longer it builds on this level and the higher probability gets back above that level, the highest probability outcome next will be the next move to the next supply zone. Can anybody tell me where the next supply zone is? All right, guys, just all you got to do is look at the chart. Can anybody tell me? There you go, 359. So your probability, right, your probability in the trade. And again, we're taking war out of the equation. We're taking tariffs out of the equation. We're just talking about bare bones technical analysis via the PS60 theory. We already know if a stock trade from supply to supply and demand to demand, well, this supply zone is the 20-day moving average, okay? I will be long the stock with both hands, both feet, 3 of my vaginas, and 12 heads above 35.50. Because if the stock finally gets back above this 35.50, we have a potential 25 to 30 point move, right? 25 to 30 point move on the stock because the next supply zone is all over here. Is it going to happen in one day? Hell, listen, I've seen Tesla, and Tesla's a very unique stock. We've seen Tesla in one day, give us the whole measured potential move. But, realistically, if that happens, we get a close of 336 within the next 2-3 days, you should potentially see a test for the next supply zone. So the key element here, guys, is kind of breaking things down. Stocks, kind of a footnote is, and again, we'll take some questions here in a second. The footnote here is stocks trade from supply to supply and demand to demand. Okay. You guys already know what your supply zones are. Okay. What your supply zones are. These are your supply zones. Okay. Stocks don't randomly stock. This isn't a cartoon when the Wile E. Coyote, drops an anvil on top of the Roadrunner's head, and the anvil in midair just stops and goes right back up. There has to be a point of reference. So stocks don't magically stop. They hit these areas, right? They hit these areas. One of these areas will generally get hit, and this is why a stock's trajectory might slowly pause or even reverse. So it's very, very important to have all these supply and demand zones on your charts. Now, here's the follow-up question, which I know somebody's already going to ask. Well, does it, my charts are a little bit off. Yes. Everybody's charts are going to be a little bit off. If you log into your Teachable account, right? And I'm assuming everybody has access to your Teachable account. Not only will you find the settings for TradingView, Thinkorswim, guys. What other platforms? Yeah, it's under training and resources. Okay. Interactive Brokers, TradingView, Thinkorswim, TC2000, and obviously TradeStation, and obviously eSignal. I use eSignal, right? I use eSignal Legacy. It's probably the most expensive one out of all of them. But if you get eSignal Legacy, you can just get my exact settings. So it's exactly to what I am seeing. Because remember, every single vendor, their data is a little bit different. Okay. It's a little bit different. So, my supply zone could be, 396.50. Your supply zone could be 396.12. You know what I mean? It could be a little bit different. I don't personally even know if mine is right. Mine has been working for a long, long time. I've been using eSignal, from, let's see, I've been using eSignal from, when was this account created? Since 2001. Okay. So I've been using eSignal for the last 24 years. So I don't know if my data is right, but it's pretty right? It's pretty right. So if you have any of those platforms, right? If you have any of those platforms, you can get our settings for that platform. Okay. We could get settings for that platform. And that's the best thing. eSignal, again, I don't even know what I'm paying for it. It could be $200, $300 a month. I don't even know what it is. It's obviously the most expensive one, but if you're a little bit longer in your career and you have a decent account and you have more money than more money than the average trader, it's definitely worth the investment. The last thing you want to do is skim on your business, right? And your charts and your data are a very, very important part of what you do. So I wouldn't skim. You could skim on your news service, right? You could skim on, but I wouldn't skim on my charts. The charts are painting a picture of where a stock is supposed to go, where a stock is supposed to stop, and where a stock is supposed to get rejected. So if you log into your Teachable, right? Teachable, number one, you will see a plethora, great word, by the way, plethora of things that we will never release to general public. There's thousands, I'm exaggerating, dozens of videos, right? Dozens of videos that are tackling every aspect of trading, from being afraid to put on a trade, to position sizing, to everything in between, right? Because every single trader has gone through exactly the same thing. There's nothing special about me. There's nothing special about you. All of us are idiots. All of us have absolutely no reason to guess where the market's going. And there's absolutely no reason to guess where a stock should stop and where stock should start. Hence, supply and demand zones. So this was kind of a little bit of a brief kind of a refresher about the PS60 theory. Obviously, the whole point of this webinar was not to dissect the whole PS60 theory. You guys who are brand new to us, your job this evening or this afternoon is to log into your Teachable account, watch the first 4 hours of the PS60 Foundation, and then there's the part 2. There's like 8.5 hours, 9 hours breaking down the PS60 theory. I just wanted to kind of do a bare bones, kind of a little bit of a review, right? And obviously, the more you see it play out throughout the day, throughout the week, it all makes sense. So we're going to open it up to questions. If you have questions of where my stop, where my start, where my stop is, where's the next measured potential, that's the whole point. And I wanted to do a very bare bones. Everything is on those 8.5 hours of training. So I don't want to waste a lot of time with things that you could just log into and see firsthand. Well, yeah, we'll get to that, Rich. That's going to be one of the two things this is going to be one of the two topics we're going to break down today. But does anybody have any questions about supply and demand? Does anybody have any questions about anything that we just kind of spoke about in the first 15, 20 minutes? Actually, in the first 40 minutes. So an inside day is when a stock breaks out and it rests the next day, right? If you look at any chart that broke out, let's use Oracle for an example, right? So Oracle on 514, right? This was the range on Oracle, correct? Everybody see it? This was the top of the range on Oracle. It was 163.40. Everybody see it? So it was in this range for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. And it finally broke out. You see it? It finally broke out on 5 the 28th. So it took out and closed above 163.40. The next day was a red day, right? The next day was a red day, basically just resting, right? It was an inside day. Inside days are bullish, are super duper bullish. Okay. Inside days are just a rest day. Again, it's like a person running a triathlon. They just ran 26 miles to break out. And then somebody told them, hey, by the way, now you have to swim for 5 miles. They're just taking a break, right? They're taking a break. They're getting a little bit of water. They're just kind of rejuicing, right? Re-energizing. And an inside day after a breakout is the most bullish day because the sellers are comfortable, right? The sellers are comfortable and they are accepting the idea that the stock broke out and there's no selling pressure. And you see an inside day is usually followed by a resumption. And this is where kind of really magnifies the whole point of once the stock finally gets above supply, it breaks out, it rests the next day, and it continues its run. So an inside day is super bullish. Okay. The best way to approach an inside day, if there is any profit taken, okay, the next day, you want to be a buyer into rising support, whether it's the daily and the 60-minute. Obviously, we'll deep dive into that in a few minutes. So inside day is super duper bullish. Let me say it this way. Let me say this much. The moving averages, there's a severity, right? There's a validity to these moving average. The further you go away, right? The further you go away from a moving average, the higher value there is on that moving average. So basically what it means is if a stock breaks out, right? If a stock breaks out, the 5-day moving average acts as the shorter term, right? The shortest term of support. Okay. The shorter term of support. The 5-day acts as the shortest point of support. So there's a higher probability after the stock breaks out, it will bounce off the 5-day moving average. Okay. But as it's starting to lose the 5-day moving average, the 10-day, the 20-day, and the 50-day act as more aggressive areas where the higher potential of stock can bounce. Obviously, the 50-day moving average is the ultimate battle zone, right? It's the absolute ultimate battle zone. There's a higher probability that the stock will get rejected or bounce off the 50-day moving average more than any other moving average for the exclusion of the 200-day. The 200-day is very rare because that's attacking the whole lifeline of the stock, the whole lifeline of the trend. So the further you go away from the 5-day moving average, the higher probability the stock will bounce and they'll defend that level. The 10, the 20, and the 50-day moving average. Like, guys, I don't want to, again, that's the whole point of the first segment is I just wanted to bare bones it. Everything second entries, everything that's literally on the workshops. Again, as much, I didn't want to focus. We could be sitting here for 6 hours if we start talking about, second entries. You follow what I'm saying? It's just, it's literally, I literally wanted to do a bare bones. And we talk about, guys, the second entries every single day. So the first 5 seconds we're in morning strategy. We talk about, hey guys, Tesla, 335.50 second entry. Let it take out 335, put in a new high, let it retrace. And once it goes through a new, you know what I'm saying? We talk about second entries literally every single second of every single day. So I don't want to spend 20 minutes talking about second entry. We literally talk about second entries 50 times a day. So everything else, folks, for all you guys who just haven't been in the webinar or what's it called? What was I saying? Been in the webinar or watched the workshops. It really breaks down everything. That's what the 10 hours are for. Okay. That's what the 10 hours are for. Okay. So that's that. Look at it. Let's kind of dive in, right? Let's kind of dive into where we're here. Okay. Let's kind of dive into over here. So everything else, folks, you'll see all your questions, pretty much every single question you potentially can have. You'll probably get that answer in the first half hour of the day on Monday. You follow what I'm saying, guys? The first half hour of the day on Monday, I bet you will get your answer to any question you have on the physical PS60 theory, whether it's entry, right? Entry, measured potential, initial measured potential, how to navigate the trade, right? How to navigate your trade, and where your max pain is. These are things you will get your answers literally in the first half hour of tomorrow's session. Literally the first half hour, because we want to make sure everybody knows exactly where these things are before you put your hard-earned money to play. So all those things in real time, you'll see them tomorrow. But for the point of today, all those questions are in the first 2 workshops. So I don't want to, you follow what I'm saying? I just don't want to be here for 9 hours. I don't, you know what I'm saying? I don't think you guys want to be here for 9 hours. I just wanted to make sure that we kind of bare bones the first aspect of the PS60 theory, and now we're kind of getting along to those other subjects that we have seen. Okay, guys. So if anybody has, let me just see. I just want to make sure if anybody doesn't have any questions that I haven't seen before. Yeah, it looks like a lot of your questions have to do with options. So that's a perfect segue. That's gonna be a perfect segue, right? It looks like a lot of you guys' questions have something to do with options. All right, cool. Yeah, perfect along. All right, guys. So what we're gonna do, and this has really been a game changer for us. This has been really, really a big game changer for us, at least for me, in the last 5 years. Okay. I'm not an options trader. I'm not. I am probably the top 3 worst person to have a conversation about options with, because I don't understand what any of this stuff means, right? I don't know what gamma means. I don't know what, Mickey Mouse means and any other things you guys talk about, right? I don't know any of this stuff. But I do understand the importance of options, and I do understand the role that the options market plays, okay? So here's kind of where we go, right? There's a formula, right? So for every setup, right? Okay? For every setup that we have, there's a common denominator, okay? So yes, Tesla has a great chart, and we all know, okay? And we all know that Tesla has a chart that if it breaks out above 335.50, right, it should give us a really potential good trade. Now, how does the options market come in, right? How does the options market give us a really good, strong belief that we are holding a pair of aces? In my opinion, most traders fail, and they run into stocks that have a false breakout. You ever hear that expression, false breakout, right? Or a stock had a fake breakout and nobody understands why the stock had a fake breakout? Well, there's a really good reason behind it. Okay. In my opinion, a stock cannot break out unless the institutional money flow is on board with the breakout. So meaning that institutional money flow usually goes into darlings, right? What do I mean by darlings? Companies that the institutional participants have on their books. Apple, Tesla, Amazon, Google, right? Names that everybody wants to own in the technology space. So I don't believe, and I think it's been documented for years and years and years, I don't believe that just a chart confirming can break the stock out. I don't believe, okay? Because we've seen a lot of times that a stock breaks out of a channel and it goes up 50, 60 cents and then it dies out, right? And the reason for that is institutional money flow is not behind the trade. Guys, I don't care what you're trading. If you don't get a McKinley Capital, right? If you don't get a Fidelity Magellan, if you don't get, if you don't get Steve Cohn behind you, if you don't get, David Einhorn behind you, if you don't have these traders, if you don't have these institutions behind you, the stock will not go. Okay, that's a whole different algo, right? The stock will never go. For a stock to go, you need institutional money flow to start betting in that stock, okay? And that's where the options market comes in. The options market is a cheat code, okay? Is an absolute cheat code that's telling you, that's screaming at you at times that institutional money flow needs and wants and betting that the stock is going higher, okay? That's the bottom line. A stock will not go higher 90% of the time unless there's institutional money flow behind it, okay? So the formula is daily chart, right? Meaning a stock that is sitting in a range that we just talked about. The longer the range, the higher probability that it will come out of that range. And now you need the institutional money flow to start betting with it, right? So for example, let's say Monday, right? Tesla closed at 322. Okay. We already know two things, right? We already know two things. We know the stock has been trading inside of a channel. Check. We know that. The longer distribution, the higher probability it'll go. We know that. Check. We know the top of the range, which is 335.50, correct? We know that's our entry, right? On a second entry. Check. So we know these three things. So now we need data. You ever hear, especially for all you guys who have never been in the webinar, you ever hear me talk about on YouTube, I'm collecting as much data as possible. Okay. I'm sitting there collecting data. And what I mean by that is the setup that I'm watching to see if the options market is looking at the same thing I am and now is betting in that direction. So how do we know, right? How do we know that the institutional money flow is just literally taking shots, right? Shots in the dark that the stock will be at $500 next week? Or how do we know if they're betting technically, or how do we know they would be betting emotionally? That's a very, very good question. It's a very, very important part of what we do. So again, we know that 335.50 is the top of the range, right, guys? Everybody know that? That's literally where this stock is going to absolutely potentially go nuts. Okay, we know that part. So what is the difference, right? What is the difference? Okay, let's say tomorrow morning, right? Tomorrow's Monday, right? Let's say tomorrow morning we start coming in, we start coming in, and we start seeing buyers come in of Tesla for the weekly 340 calls. Another guy comes in for the weekly 345 calls. Another guy comes in for the 335 calls. Another guy comes in for 2 weeks out of the 360 calls. Another guy comes in for 345 weeklies. And they're just pounding and pounding. That's what she said. And pounding and pounding. And all you're seeing is massive option flow over and over and over again, right? What does that tell you? Right, guys? What does that tell you? The first thing that should tell you is the institutional money flow is starting to bet that there's something about to happen, that Tesla is going to see price action, and we're finally going to confirm 335.50, correct? The more option flow you see, the better it is, guys. We don't want to just see one guy come in. We want to see over and over to the point of like, guys, more and more. Holy crap, look how much they're coming for. Guys, millions are being bet. And the more option flow you see, the higher probability when the stock finally gets to that level, your confidence, right? Your confidence should be sky high, correct? Think about that. If you're already seeing, it's not some Twitter trader betting $1.5 million that the stock is going to be, 15 points higher by the weekend. These are institutional money flow. So the idea that once the stock confirms and gets to that level, you should go in with extreme confidence, with extreme prejudice at that level, that the stock should continue and should finally to explode, right? If there is no option flow, right? Or one guy comes in, 335s, or the one guy comes in, he's betting for the August 360s. Like, for example, right? You see this dude that came in towards the end of the day? Guys, you see this guy came in for the rest of the day? Okay, this guy came in for $200,000 for 2 weeks out, 11 days, right? 2 weeks out that the stock is going to be at 360. This does nothing for me, right? You know why this doesn't do anything for me? The guy's betting 40 points out of the money with 2 weeks left. Why? Right? What information am I getting? What confidence am I getting? Well, it's not even necessarily even a sweep. Let's just say this was a sweep, right? And we'll break down the difference in between. Like this guy coming in, right? This guy coming in and going, he's betting 200 grand. He's taking a shot. I think based on the robot, I think based on the self-driving car, well, I think in 2 weeks Tesla's going to be at 360. Why? Why do you think it's going to be at 360? Well, just because. This is not what we want to see, right? Let me just look at the option flow in Tesla. right? So this is the option flow on Tesla. Okay. We don't care about this guy. You see that, guys? We don't care about this guy for the 360 weekly calls for 2 weeks out. We damn sure don't care about this guy. You see that, guys? It's cool, right? It's cool. The guy's coming in for the October 400 calls. All right, it's cool. But why? Think about it. Why? Why do you think the stock is going to be at 400? Let's just take, Vlad, let's just pretend these are natural bets, right? These are natural bets. Why are you betting 80 points out of the money? Why are you betting 40 points out of the money if the chart is not ready to go, right? These are called emotional bets. We don't care about these bets, okay? What we want to see is a guy coming in, and obviously Friday, the stock was in the middle of the channel, as you can see here. There's no significant bets. What we want to see come Monday or come Tuesday, right? Again, remember, the stock is trading in a long channel. What we want to see, knowing the 335, we want to see a guy come in for 1.7 million for the weekly 345 calls. $2 million, right, for the 335 weeklies. 600,000 for the 340 weeklies. Why is that? Because they're coming in for short-term expiration, deep out of the money calls. We want to see them being emotional. We want to see them being panicking to get into the stock. We want to see them sweep all these stocks, right? We want to see them sweeping these stocks. We want to see them panic to get into the trade. We don't want to see one guy to come in and go, yeah, the stock will be at 400. Yeah, okay, cool. Why? Right? So the more, guys, keep this in mind, the more that a stock is getting short-term expiration, right? Meaning 2 weeks or under, obviously the weeklies are the most important part. The formula and the magic cheat code is, and I'm going to type this into the channel. Here's the key, right? Daily chart, right? Daily chart plus option flow, right? Equals results, right? Results. If I could spell, it'd be great. Results. Okay. I have this formula, and I kind of started coining the phrase, if there is no flow, there is no dough. Right? If there's no flow and there's no dough. Imagine right now, you on Friday, you bought this week's 350 calls. Why? Why? I bet you the person who sold you these calls, right? I bet you who sold these calls will probably take your money 99% of the time. Don't bet emotionally, right? You hear people all the time going, especially new traders, you hear this all the time, right? People say this all the time. They turn around and go, yo, bro, I'm taking the lotto that Tesla's going to be at 350 this week. Okay, I just took a lotto that you're a moron. And I say that, of course, in the most respectful way. You're taking a shot guessing, right? You're taking a shot guessing that the stock is going to go in your direction. And this is what we talk about all the time. Trade the market you have, not the market you want. There is absolutely no indication telling me from Friday's close that the stock is going to be at 340 this week. Right? Well, you guys have been trading this for a long time. Is there any indication that the stock is at 340 this week? Is there any indication the stock is at 310 this week? Is there any indication the stock is at 400 this week? Is there any indication the stock is 280 this week? You're guessing. Okay? Guys, we're morons. All of us are morons. We're heathens, right? We're idiots. Idiots and morons and heathens, our opinions are worthless. That's why price action is telling you everything. So when you see a stock stuck in a range, right, and you know the top of the range and you know the bottom of the range, that is your sexy time, right? That's where your explosions or implosions happen. Everything else in between is we don't care. Tesla's my favorite stock. I would rather trade Tesla blindfolded than trade any other stock on the planet. So the idea that I know the top of the channel, I know the bottom of the channel, and now I need to see the market, right? I need to see the options market start betting aggressively. Now, if they start coming in for the 340 weeklies on Monday, over and 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 over. Guess what? All in my head is I'm thinking to myself, well, the more I see this happening, all it takes is I'm saying to myself, damn, how much size do I want to go when this thing finally goes? Because if guys coming in for $5 million for this week's 340s, yeah, right? Right, guys, think about it. The more option flow we see, don't we get more and more excited? Right? Because we already know what's about to happen if the top of the range gets confirmed. So it's a very easy formula, but most traders will never understand this because, again, they don't have relevancy to understand the purpose of a range, right? And again, that kind of goes through the whole basis of the PS60 theory, right? They have the whole foundation of the range. We know what happens when a stock gets out of the range, but the most important part is the options market, guys. Again, the more option flow we see, the more option flow we get, and the shorter term expiration, when the stock finally gets above that level, man, that's when you want to take a swing, folks. That's when you really want to take a swing. And again, I will never FOMO anybody, right? I will never FOMO anybody because, again, I understand how impressionable new traders are. But if you guys remember, when Tesla was at 295, right? And all we kept on doing was waiting and waiting and waiting and waiting. And I'm like, and we kept on saying, hey, Dan, is this a macro trade? And I'm like, look, guys, I'm not going to put you in a situation that mentally that you can't handle this trade. But let's just say, yeah, right? You kind of want to go a little bit there. It's kind of a macro channel. They're coming for the 310 weeklies, 315 weeklies, 320 weeklies, 295. We kind of get it. You know what I'm saying? So I'll never put you in a situation that you're not comfortable. But at certain points, when you see a stock trading in a channel and you know the importance of that channel, and then, David Einhorn steps in, and then Steve Cohen comes in, and then, Fidelity Magellan steps in, and Wellington Capital steps in, and all these other hedge funds come in, and they start betting and betting and betting. Yeah, you might want to take a little bit of a swing, right? You might, because again, that level is so important. Just to give you an idea from the risk aspect, right? From the risk aspect point of view, that level is so important that if the stock doesn't respond right away, right? If the stock doesn't respond right away off that level, my maximum pain is going to be $1 in that stock. Right, guys, think about it. We all know how important this 295 level is. So if the stock doesn't explode in the first 45 seconds above this 295.5, 296 level, we know there's something wrong, right? We know this trade is compromised. We know there's a potential reload seller in the crowd. So even though I know the importance of that level, I also understand that the stock has to explode off that level. Because if it doesn't, that means there's something faulty there. There's something there that we can't control. Because again, if Fidelity Magellan is sitting on the other side of that trade and he wants to sell, right? And he wants to sell 5 million shares of the stock at 295, I don't care how great the stock looks. We will not be able to get a price action off that move. So for me, I would really take a big shot, right? I would take a really, really big shot off the top of the range with the option flow with a max pain of $1, right? Max pain of $1. Because again, if that stock does not get back above that level, then we have nothing to talk about, right? And when the stock finally gets above that level, if you're an options trader, right? And we already know based on our previous conversations and previous time in the webinar together, we all know, right, guys, what's the next supply zone? Right? What's the next supply zone on Tesla? Right? Correct? Look at the next supply zone on Tesla. If the next supply zone is nearly 359, 360, right? If you're an options trader, you might want to take it, you might want to start betting in that direction. Obviously, don't give yourself a week worth of time. But if you know your next measured potential is 360, right? Like Larry and Matt do, give yourself a couple of weeks. Maybe start betting the 350s, right? Give me the 350s, okay? The 350s, the 360s, give yourself some time. But if you believe in the theory that stocks trade from supply to supply and demand to demand, then once it gets above this 335.50 level, right? Any close above it, you should see a high probability of roughly 360 in the next coming days. So in my opinion, right, in my opinion, you could physically take a shot. I mean, you could really take an aggressive home run shot. Again, Derek Jeter didn't go into the Hall of Fame by hitting 800 home runs. He went into the Hall of Fame of having 3,500 hits, probably around 200 home runs. And the whole point is, right, the whole point is at some point in this business, you have to take a swing, right? Even if you strike out. If I strike out, I strike out for $1. If I'm right, we get 25, 30 points. Guys, everybody see that? If we're right, we have a measured potential of 25, 30 points. If we're wrong off this macro channel, we lose $1. Everybody see that, guys? Guys, everybody follow me on this? And that's the whole point of understanding the importance of channels. That's the importance, finding the importance of the options market, betting in that direction. Because if all the elements are there, you got your chart, check, right? Chart, check. Range, check. Option flow, check. You should have absolutely no discrepancies in your mind. You should have all the intangibles and all the data available to you that gets all the check marks, that checks off the bounces, that the trade is going to work. And if the trade doesn't work, you lose $1. So you have $1 risk with a potential $30 risk reward. Right, guys? That's the whole point, folks. That's the whole point of trading. We talk about this all the time in the live webinar, okay? The question I always ask is, do you want to make money or do you want a winning trade? Right? For all you guys who don't understand the difference, a trade for 50 cents $1, it's a winning trade. Okay? For a trade that potentially could give you 25 points in 12 hours, that's called making money. Right? If you're a professional trader, the longer you trade, I'm on my 26th year. Next May is me 26 years, right? Or is it the shiz? Is it me 27? I started when I was 24 and 51. Jesus, long time. Anyway, 26. Anyway, so when you have all this data, right? When you have all this data, okay, you should have the utmost confidence knowing that your max pain is $1, that you say to yourself, look, I'm usually a single doubles hitter, but a man got to step up to the plate, right? Step up to the plate, squeeze the bat a little bit tighter, and try to swing for the fence. This is a swing for the fence type of trade. Guys, this is a trade, right? This is a potential trade that can make your week, month, quarter. It really is. Because when you have 1 point risk and a potentially 25, 30 point reward, that's called a making money trade. That's not called a trade, a winning trade. I don't care about winning trades. I want to make money, right? I want to make money. And that's the whole point of the PS60 theory. We put you in a position identifying the macro trades, the highest probability risk reward that you could take a swing. Now, again, does Tesla break out of this channel clean? I hope so, right? I hope so. I think all of us hope so. But, in case it doesn't, I lose $1 and we wait for that seller to get cleaned up to get back in. Again, there's absolutely no reason. This isn't real estate that you need, it's a liquid model. You don't need, in real estate, you need one buyer, right? Tesla's liquid. Stock market is liquid. Even if it fails the first time and there's a notable seller, we can just wait for that guy to get cleaned up and just buy it at a higher level, right? So it's very, very important. So option flow, right, guys? Option flow, daily chart, and measured potential is your formula, okay? I don't know how I went through the first 20 years trading without option flow, okay? If you guys notice, I'll only, especially with the non-beta names, I'll only trade stocks with option flow. I will not trade it, especially non-beta names. I will never trade a stock without option flow. So, for example, if you guys saw, I give you guys perfect examples, okay? Perfect examples coming out of channels. If you guys remember, on June the 16th, we had a really big rally on June the 16th, okay? And I'll show you exactly the correlation of those days' pivots in the options market, right? So if you guys remember June the 16th, there was a lot of option flow coming out of PLTR, right? June the 16th was right here. June the 16th, 11, June the 16th. There you go. So you see this whole move here, June the 16th, right? We had a pivot. If you go through the Twitter feed, right? we had a pivot of, you know what? Actually, let's go through the Twitter. Let's go through the pivot feed. Let's go through the pivot here. Kind of show you guys, kind of put a visual behind everything. Reddit. DraftKings. Here's the DraftKings pivot. We talked about it a little while ago in PACS. Google Voyage Craft. Where's June the 16th? June 16th should be... All right, so here's June the 16th, right? Here's the June 16th. Okay, everybody see it? June the 16th. So PLTR, there was a pivot on PLTR, and the big number there was 140. If you guys remember, 140 was trading like a 4 or 5 day range, and 140, if it opens below, use that as a natural pivot. Now, if it opens above, use 140.75 as the pre-market highs, needs to confirm as well. So if you guys remember, write out the word go, right? Write out the word go. It gets above this 140.75 area, and they started pounding. If you guys remember, they started pounding the August 180 calls. I know a lot of you guys caught that. And PLTR went up $5. It didn't go $5 because the stock broke out. The stock didn't break out at 140. This was a continuation pattern, right? The stock broke out a long time ago, broke out above $97. But the last range that it broke out was above this 135 area. So there wasn't anything significant above 140. Just all it was is it got rejected there twice in the last 3 days. So once we started seeing those pre-market highs get confirmed, right? Those pre-market highs confirmed. If you guys remember, in the first half hour or so, they were pounding the 180 calls. You guys remember that? 180s, 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 180s. The stock put up a $5 candle at the open, right? And again, it didn't put up a $5 candle at the open because the chart was so explosive. It was one big continuation channel. The reason why I put up a big candle is, guys, they were coming for a month and a half out, 40 points out of the money. Now, again, to my argument is, did they know something? Are they betting emotionally? Right? They can't be betting technically, because how can you bet technically 40 points out of the money on a continuation channel? But the point was, we saw the institutional money flow. Guys, they were coming in for 500,000, 600,000, 800,000, 300,000. And we saw it over and over and over again. And what resulted was a $5 move at the open. Again, it was very, very important. Now let's take the other aspect of it, right? The same day we saw Meta. You guys remember that? We saw Meta. It was literally the same day. We saw Meta, right? We saw Meta, and Meta was going sideways. And they were coming in for the 720 and 715 calls. You guys remember that? They were betting 715 and 720 calls. Now, the question is, well, why are you betting 715 and 720 calls if the stock hasn't confirmed yet, right? Guys, can everybody put into the room? I think by now everybody knows. Can everybody put into the room what our price was to enter Meta on that 715, 720 call buyers? What was the price that we wanted to buy Meta? There you go. 709. Did Meta confirm 709? Right? Did Meta, anybody, did Meta confirm 709? Right? So those guys that were betting 715, 720s, were they guessing, or were they betting technically? Right? They were guessing. They were anticipating that Meta was going to go to 720. For me, I'm not smart enough to guess. I don't have a crystal ball. So for us, there was no trade. You know why there was no trade? Because Meta never got back above that 709. 709 put in a range of 1, 2, 3, 4, 5, 6, right? Friday was day 7. So it was going sideways. It looked great, right? We had it on our watch list literally every single day. But at no point did I ever turn around and go, you know what, guys? Let's kind of screw everything we've been talking about for the last 16 years. Let's take a guess that Meta is going to go to 720 this week. Let's all get long. For all the option players, come on, they're betting, right? They're betting. He's coming in for 500 grand for the 720 weeklies, right? Just take a shot. You're guessing. And guess what happened 2 days later? The stock died, right? So my question to you guys is, right, were they smart or were they just stupid and taking shots? Again, guys, it goes to the theory. A stock is not a trade, right? A setup is not a trade in to take occurs. They could come in for $200 million for the weekly 800 calls on Tesla. I will not look at this thing until it takes out the top of the range. That's the discipline. Folks, do not anticipate. Do not guess. We're not smart. Repeat after me. We're morons. Okay? Those guys who are betting hundreds of thousands of dollars on last Friday's expiration, they went to zero. Their $500,000 bet went to zero. Their bets all went to zero. You know why? Because they were guessing. They were anticipating. You guys who trade solely options, you can't afford to guess. You're fighting time. Think about that, guys. You guys are fighting time. I'm an equity trader. I could break even in the trade, right? I could break even in the trade. Think about it. I could break even on the trade. Slippage, up a little bit, down. I could break in the trade. As soon as the stock stalls out with you guys, you lose 20, 30, 40% of your money, right? So if you're an options trader, you can't guess. You can't anticipate. Let the effing thing confirm. Now, once it would have gotten back above 720, then yes, right? Then yes. Of course we would have got long. Of course you option traders would have taken the 720 weeklies because that's where the options market was betting. But until that happens, baby, no flow, no confirmation means no dough. Anticipating will kill you, right? Guessing will kill you. Yes, the options market was betting, but the options market was guessing because the stock never confirmed. Let's look for another example. The same day, AMD, and again, congratulations for all you guys who caught AMD that day, right? AMD, okay, AMD, we had a pivot, right? Let me see what other pivots were. Let me see if it was the same day. Yeah, so as everybody sees, 333 and 3550. This is June 16th, guys. We're a week later, still the same number, okay? NVIDIA gave us a trade, right? NVIDIA gave us a trade. It wasn't a great trade. I think all of us pretty much got long NVIDIA that day. 145 rejected several times. If you guys remember NVIDIA, they were coming for that day. They were coming for the 36s, the 46, the 47, the 48, 49s, right? If you guys remember. So the options market was there. You guys remember that trade? Joe, you guys remember that trade? 45s. They're coming in. We knew that 45 area got rejected several times. 45, 45, 45. So we knew there was massive flow coming into the options market. But guess what happened, right? So all those guys that were betting 46, 47, 48s, 49s for the weeklies, guess what happened? Only the 46 is paid, right? I got long 45. My highest sale was 46. The stock put in the high of 46.17. And guess what happened? Stock died, right? The stock died. Which basically tells you is, and we kind of go over this all the time, there's no guarantee that the stock will ever reach measured potential. Right, guys? Think about that. There is absolutely no guarantee that the stock will ever reach measured potential, which basically tells you is, and I think Boris was really got it, especially on Friday, what you always want to do is give him stock on the way up. Guys, always remember these words. We don't work for free, okay? Just because they're betting 48, 49, 50 doesn't mean they'll get there, okay? Because there's geopolitical risk, right? There's war risk. There's tariff risk. There's risk all over the place. So it doesn't mean that it will meet its measured potential. So even though my highest sale was 46, right? I had kept enough stock to get it to 48, 49. It never got there. And you know what the end result was? We all pretty much stopped out break even, right, guys? Break even on the balance. So here's a lesson, right? Here's a very, very important lesson that if you first 15 minutes in the webinar, it's gonna be tattooed on your brain. Take money, right, guys? You're Pac-Man. You're Miss Pac-Man. Just because they're betting in that direction, just because technically all signs point that it's going to get there, it doesn't have to. So always take money along the way. Always keep a runner to measure potential. And once you get that, once you get cash flow on the stock, go to break even as you stop. And that's it. Keep a runner until the stock either reaches measured potential or you get stopped out, right? Very, very important to understand. Let's look at Tesla, right? Let's look at Tesla. This is exactly my point. The same day, right? Here is the pivot, right? We all know this is the pivot. 333 and 335.50 needs to confirm, right? I think by now everybody knows the big number on Tesla going to this week. That same day, right? That same day, they were coming for the 350, 250 weeklies. You guys remember that? 350, 250 weeklies. Why? Right? That's the question. Why are you betting 20 points out of the money? Why in God's name are you betting 20 points out of the money with a week left of expiration if the stock hasn't confirmed? Think about that. Think about that. Guys, if you're trading options, especially, you need to be 1,000% correct that the stock is above supply. All of us who trade equity, we could be wrong and still make money on that trade. And what I mean by that is, I could be in a Tesla pivot. It goes up $1. Like if you guys remember on Thursday, remember we bought that opening range high on Tesla at 331, and I was anticipating that I was going to get above 33 finally, and it went to like 32 and change. And I didn't make any sales, right? I was anticipating, but at least I was anticipating. I at least already had $1 in change on the trade. But these guys are anticipating that the stock was going to run up 20, 25 points higher without a confirmation. You follow what I'm saying, guys? So the moral of the story is, and we'll open it up for questions. The moral of the story is, number one, you need a range, right, that we talked about now extensively. You need repeat call or put buyers, depending which way we're trading the stock. We need repeat call. Let's just use call buyers in this situation. Repeat call buyers, okay, in that direction. The shorter term expiration, the better. We want to see 1,000 buyers come in for the weeklies. Deep out of the money calls, weeklies. The more repeat buyers we have, the higher probability once it confirms, it gets there, right? It gets there. It's a very, very important part, okay? Absolutely do not guess. Do not anticipate a stock moving in that direction, because as we've seen with examples of Meta weekly call buyers and Tesla weekly call buyers, you know where they're now? Their money's at zero, right? Maybe one day they will guess properly. But again, folks, we're not in the guessing business. We're in the data and collection business, and we wait for the confirmation. So if there is no confirmation, there is no trade, right? Everybody understand that, guys? And where's your profit margin, right? Where's your profit margin and measure potential as in the most basic part of the PS60 theory? Again, if you believe in the theory that stocks trade from supply to supply and demand to demand, your next profit potential is your next supply zone. But your next supply zone, you're already down to a runner, right? Whether it's your last 10%, whether your last 20%, your measured profit potential is to your runner, not your full trade. So the way I would trade Tesla, right, knowing there's a potential 25-point channel, right, there's a big measure potential from the equity side, I would start piecing out 10% of the time every $1.50 up, right? Every $1.50 up till we got to about up $7, $8 in the trade, and I'll be down to probably about 40%, right? Because I also know there's another $10 in the trade. I want to get as much meat of the bone as possible, because not every single day you're going to wake up and you have a potential 25-point move in 24 hours. So you don't want to, sell Tesla 50 cents. You know what I'm saying? You don't want to sell 50% of your position of 50 cents knowing you have $25 in the trade. So the most important part is not every single trade is going to be the same, right? Not every single day is going to be the same. Some trades are going to give you bigger measure potential, and that's where you want to be a little bit more passive in taking profits. Obviously, still take profits, but more passive. If a stock has a $3 range, that's when you get more aggressive by taking profits, right? Like if I know there's only $3 in the trade, right? If I only know there's only $3 in the trade, yeah, the stock goes up $1, I'll give them 25% because there's only $3 potential. The stock goes down up $2, I'll be down to 25% because there's only $1 left. But when you have 25, 30%, that's when you want to give it a lot more room and be right. Because again, guys, at the end of the day, I don't want to lose $1 on full size, right? But there's always that potential it stalls out and you lose $1. But for the $1 that I'm risking on this, I don't want to call it a macro trade, but it's getting pretty damn close, right? I know I have 25 points of upside, 25 to 1 risk reward. Yes, please. On the greatest stock ever to trade on the planet. You follow what I'm saying? So the key to this business, always remember, guys, the more data you have, right? Chart-wise, options market size, right? And the periods of extreme betting in that direction with short-term expiration, that is your cheat code that the stock is going to do well, and your performing on that interval is going to be magnified based on all the elements that we just talked about. So we're going to open it up to questions. Then I'm going to take like a 5-minute break, kind of clear my voice, go to the bathroom, and then we'll discuss bounces. So if I don't answer all your questions, I promise I'll answer them throughout the week. Let me see what Joe says. Dan, can you use the current pivot watch list as an example? Yeah, sure. What do we have for tomorrow? Let me see what we have for tomorrow. Let's just assuming there's no craziness that comes out with war, right? Let's just say the market handles war tomorrow. Yeah, all right. So let's talk about it. All right. Let's use BKSY as an example first, right? So BKSY, yeah, I'll take it after this Q&A. So BKSY on Friday has gotten above this whole channel here. And this is kind of my whole point of you don't need to trade Tesla. Like I personally wouldn't trade BKSY because that's not my thing. But again, it goes back to the theory that option flow, as long as the stock has a range and has volume, you can trade anything, right? You can trade literally any stock. So if you guys remember the previous night, and I know Ivan is still long, I believe, we had PACS, right, guys? We had PACS. It was sitting in this big channel going all the way back to 513. You guys remember that? It was on Wednesday's watch list. So if PACS gets above 1241, it should continue because it had this big expansion channel, right? This big expansion channel. And the next day, when it confirmed 1241, I believe the second entry was 1250. You guys remember? I don't know if Ivan's here. But if you guys remember, 1250, I believe, was the second entry. And the stock went from 1250 to, all the way up to almost 14 in the next 12 hours. Now, something like this, I personally wouldn't trade, like me personally, because again, I have zero interest in it. It's just not my thing. But if this thing had option flow, right? If this thing had option flow, okay, so you can see here, if this thing had option flow and they started coming for the 14s, the 15s, this would obviously get my attention because now you have a smaller stock, right? An obscure name with volume expansion, range expansion, and your next supply zone, right? Your next supply zone was right over here, roughly the 1270 area. And once it got back above the 1270, your ultimate reward is 1440s. You see that? So your ultimate 1440. So I don't know if Ivan's still on. I don't think Ivan's here. So the point is you have 1240, right? 1240 confirmation. I think the second entry was 1250 if I recall. And now your measured potential is all the way up to 1445. Everybody see that, guys? Joe, you see that? 1445. So my point is when you look at BKSY or BKSY, you have the same type of scenario, right? You have the same type of scenario. It's coming out of a range, big expansion flow, right? And now it put in a high on Friday of 1474. Again, I'm personally not looking at it, right? I couldn't care less about it. But if you are trading this thing, and again, let it get above 1472, right? That was Friday's highs. Let it put in a new high. Let's pretend it puts in a new high of 1496, right? Let's just pretend. 1496, let it retrace 20, 30 cents, And once it gets above 15, that is your entry. And now the question should be, well, Dan, I don't see the next supply zone. Where's my next measure of potential, right? If there's no, that's actually a good thing, guys. When you don't see the next supply zone on your chart, that's a good thing, right? That's what you want. But you have to ask yourself, you have to have a point of reference, right? You have to have a point of reference of where can the stock actually go. And that's when you want to start looking left to where the stock actually came from. So your next measure of potential is, you can see here is 15, right? So 15 is a really important level. And after 15, you keep on looking, you go, okay, 1550. After 1550, you look at 16. Or you can do is go to the weekly chart, right? And go to the weekly chart, and now you have an understanding, right? And now you have an understanding of where your next supply zone is, right? So you have 15. Actually, 15 is a very important level on BKSY. You see that, guys? 15 is the high from 313, and basically 15 was the high from Friday, 1470s. So this thing, if it could get above 15, you see how much room you have? Joe, you see how much room you have, guys? You have room all the way up to 18 on the weekly supply. So you want to gauge your next level of potential either on the daily chart, and if the stock has no supply on the daily, switch to the weekly chart, right? You want to have chaos, exactly. That's a good thing, guys. If somebody says, "Hey Dan, Circle is a 250, where can it go?" I go, I don't know, higher. There's no data, right? There's no data behind these things. That's a great problem to have. You have the greatest problem to have, right? The greatest problem to have is that you don't know where the next supply zone is. You follow what I'm saying? You don't know because it's an uncharted waters, right? It's uncharted waters. So you don't know, which is usually a good thing. It's usually one of those scenarios that's a gift, right? That's a gift when you don't have supply. Now let's look at the downside, right? Let's look at the downside. Actually, let me give you one more example to the upside, right? So HNGE, usually a name I wouldn't want to watch, but let's be honest here. The IPO market is pretty explosive right now, right? If you guys look at Circle, right? Circle got above its IPO highs and the stock went nuts. CRWV, and by the way, I didn't have CRWV on my bingo card on Friday, but my first trade on CRWV gave us, a couple of bucks? And then our second trade on CRWV gave us $5, which I was stunned. But my point is not from Friday. My point is, look what happened when CRWV, right, got above its IPO highs, right? It got above its IPO highs of 64, 62, correct? And obviously, there was no area of interest here, right? We didn't know where the next supply zone is. So when you look, for example, like a stock like HNGE, right? If it takes out its IPO highs this week of 43.80, we don't know where it's going to go, right, guys? Think about it. There's no data where it can go. We have no idea, but that's a good thing. All we do know is the IPO market has been hot. People are chasing it, and there is a world where this thing doubles, right? Circle doubled, CRWV has doubled. There is a world out there, or there's a world the stock goes up $1 and shits on itself, and then we never look at it again, right? So the greatest thing about trading, right? Oh, am I? Oh, it doesn't. No, am I? No, I'm on David. Yeah. So the greatest thing is when you're trading a stock that has no ceiling, right? When there's a stock that has no ceiling, guys, that's what we want. Like, my worst problem is eventually Tesla breaks out and there's no ceiling. Jeez, the stock will be a runaway train for a month. So that's a good thing, guys. That's an absolutely good thing. But here's the flip side, right? Here's the flip side. Let's talk about NVIDIA, right? Let's talk about NVIDIA. So as mentioned on, oh my God, I'm losing my voice. As mentioned on the weekend video, right? NVIDIA's been on a great uptrend, right, guys? Been on a great uptrend. and it broke out above the 50-day. Like, this was a great pivot we had, right? This was a great macro pivot we had because it was reclaiming the 50-day moving average. Guys, you see what happens when you reclaim the 50-day? Guys, you see that? What happens when you reclaim the 50-day moving average? It just goes, the dynamics of the stock completely change. So here's my point, right? And here's the other side of the equation. Let's say, the market just is afraid of the war and this, that, and the other thing. You see how many times it held the 10-day? It held it once, twice, 3 times, 4 times, 5 times, right? If, say, NVIDIA starts losing this 42 channel, right? Because it's held 42 several times. Your next measured potential, right? Your next measured potential is right here. Because again, if you believe in the theory that stocks trade from supply to supply, well, then they trade from demand to demand, right? So here's the next demand zone, right? 140. If it starts losing 140, then it goes to 135. So here's a reference point to the downside, right? Your measured potential is 140. Now, again, from 142 to 140, it's not that big of a deal. That's a trade that I would turn around and go, yeah, you can make money. It's not just a winning trade because $2 on NVIDIA is good. Hell, 50 cents. If you're trading NVIDIA, for every 50 cents in NVIDIA, it's like $2 of Tesla. So 50 cents on NVIDIA is a good move. Again, maybe not for a new trader, but 50 cents on NVIDIA is a good move. So if you get a $2 move, it's like literally the equivalent of getting, 4 or 5 points on Tesla. So if you have a $2 move on potential on NVIDIA, how I would trade it, right? Knowing there's a $2 move, I would sell, 25, 30% that first 50 cents, because that 50 cents is a lot, right? Same thing with Apple. It's a lot. And then I'd start, piecing out to have about 25% left, with about 50 cents left, right? So the stock right now is at let's just say 40 and a half, I'd be down to 25%. If it gets down to 40, I'd get down to 10%. And just on the case it keeps on going, we have another $5 worth of room. But here's an example. You have $2 worth of room, right? You have $2 worth of room for the trade. And on the upside, right, if it gets above 46.20, right, you can see here it stopped at 46.20 on June the 16th. It stopped at 46.20 on Friday. If it starts getting above 46.20, well, our upside is 48.70. Everybody see that, guys? Our upside is 48.70. So you have upside potential of 48.70. That's your next supply zone. And your downside potential is 140. So what I want to see, if I'm trading to the downside, I want to see them Monday, tomorrow, start pounding those 140 weekly puts. 140 puts, 140 puts, 140 points, 140 points, 135s, 135s, 140s, 140s. We don't want to see them buying 145 weeklies into dips. We don't want to see them buying 150s for next month. We want to see price action in the direction that we want to trade the stock. And that eliminates the guesswork. So again, it would be another example of the stock, instead of taking out its daily supply, we're confirming its daily demand and going to its next demand zone. Okay. So that's that. That's kind of like on our real-time watch list coming in for Monday. Now, obviously, I don't know how the futures market is going to react or overreact, right? We don't know that. Okay, we don't know that. So we could come in on Monday and the video is at 138. You follow what I'm saying? Like all our setups could be destroyed, could be absolutely destroyed. And then obviously, we have a plan B for that as well, which obviously we'll talk about at morning strategy, but maybe consider a rejection, maybe, whatever the case may be. So we have to see how the futures market opens up this evening. Obviously, the United States participation in a military, exercise by, taking out their nuclear plants is kind of a big deal. I haven't been on social media, obviously, since we started in the last 2 hours, so I don't know if there's any news that is broken, but obviously the futures market is going to dictate to us, right? It's going to dictate to us how the market and how the futures react or overreact come into Monday. So guys, what I want to do is, because I feel like I've been speaking a little bit for almost 2 hours now, I just want to take a 10-minute break, just get some more water, go to the bathroom, go stretch your legs, come back. It's 10 minutes to 11 right now. Come back in 10 minutes, and then we will get to the bounces and rejections part of this segment. Okay, guys? Any last minute questions before we take our little 10-minute break? All right, cool, cool. All right, guys. I'll see you guys. I'll see you guys in 10 minutes. Just gonna finish up this last segment, a half hour. Take a half hour, right? All right, let's give it one more minute and we'll get started again. It's so funny. I speak for 6 hours a day, but if you're speaking 2 hours straight, it weighs on your. Yeah. I'll go to CVS after. My throat is killing me around. Okay. All right, guys. Is everybody back? Everybody back? All right. Cool. All right. So we're gonna wrap it up, obviously, on this section here. Guys, always remember, and this is kind of where we started. We started this webinar, especially if you're brand new. Okay, you're not gonna understand any of this stuff, right? I always joke around. I joke around. I get this email all the time. Hey, Dan, I just had my first green month ever. And my response to them is, yeah, that's great, but you have no idea what you're doing. I'm like, yeah, that's great, but you still have no idea what you're doing. And that's the point. It's okay, right? It's okay. We've been doing this for I've been hosting this webinar for 16 years, and everybody starts out the same way. This is all brand new. This is something that they've never seen before. And the reason why you don't understand it is this is why it's our edge. And the most important part is we continue, hopefully every year, add to more things that will, expand our edge. And whoever's on the other side of our trade is probably not going to be in a good space after, we're done with them. So don't feel like, even if, you're sitting here for 2 hours, this is all like, a Martian language to you. The more you attend the webinar and you see it play out, you're going to turn around and go, okay. That's why I wanted to this is why I wanted to make sure everybody was in the webinar first and then, do the workshop. So you see it playing out versus that you've never seen this before. And I apologize. My throat is shot right now. So at Friday, for example, there was a bounce play on CRWV, and there was a natural pivot on CRWV. But if you never saw the bounce on CRWV on Friday, what we're about to talk about makes no sense to you, right? But the good news is it'll make sense to you tomorrow, Tuesday, Wednesday, Thursday, Friday, next following Monday, Tuesday, Wednesday, Thursday, because that's, again, this whole point. We're applying the principles and you get to see it play out in front of your eyes. So bounces are nothing new, right, to the world. You see new traders talk about all the time. I'm taking a bounce. The stock is oversold. I'm taking a bounce. The problem is we're taught right from the womb, it kind of feels like, that the market eventually will go up, right? No matter how bad the stock looks, eventually your stock will bounce back. Yeah, I guess. History has, if you go back to history, it's shown us, if you go through a monthly chart of the NASDAQ 100, history is showing you, no matter how bad it's been, right? Going through the mortgage crisis, going through 9/11, going through COVID, the market just always finds its way back to, right? Always back to highs. So the theory that you can buy the dip makes a lot of sense. The problem is a lot of traders, especially new traders, they don't have the risk tolerance like a fund manager who has a 5-10 year horizon. So for example, if Tesla goes from 400 to 200, a fund that's worth $2 billion will be all right. A person buying the dip from 400 to 350 and it goes to 200, well, there's a chance their $10,000 account is worth $2,000 now. Or whatever, just almost easy number. So the theoretical act of buying the dip is important, but not for the average person. Because number one, the only way to buy the dip is a stock has to be in an uptrend, right? Isn't that the most basic thing? You can't buy the dip if the stock is not an uptrend. That's why February of this past year was one of my better months, because we lost the 50-day moving average. And what I heard, and you guys remember, I used to joke around all the time. This first day we closed below the 50-day moving average, there were people on YouTube saying, "Hey Dan, the market is oversold," and I'm like, "How can it be oversold if this is the first close below the 50-day moving average?" And what happened was, well, those people who are overselling, right? Because again, Qs went from 540 to 519, so they think it's oversold. The problem was here, we were below the 50-day moving average. And what transpired for the next month and a half is we went from 540 on the Qs all the way down to 402. So it's 102 points on the Qs, which basically tells you is not all dip buying is the same. Not all bounces are the same. So here's the first rule, right? Here's the first rule before we even deep dive into it. Under no circumstances, okay, I don't care what religion you are, what God you pray to, under no circumstances do you ever buy the dip on a stock that's below the 50-day moving average. Okay, I don't care if Jesus is standing on your shoulder and say, "My son, you will be all right." Nah, son, I'm not going to be all right. We're below the 50-day moving average. We're not going to be all right. That's the point. So under no circumstances, on any conditions, do you ever buy the dip on a stock below the 50-day moving average. Again, above the 50-day moving average is bullish. Below the 50-day moving average is bearish. So here's the counter, here's the counterpoint. But then what's the difference, right? What's the difference? If I buy the Qs, if I buy the Qs at 476, you already said history has proven that eventually it will go back to highs, right? History has shown us that. Well, that's cool. Are you willing to sit in stock from 476 to 400? Right? That's a very fair question, right? How many of you guys can sit on the Qs for 75 points against you? It's a very fair question. And what happens if the sellers didn't get tired at the bottom of the range here on one random day? Yeah, we could have been having this conversation at 350, right? So theoretically, yes, you can definitely buy the Qs wherever the hell you want. And if you have a 5, 10, 15-year horizon, eventually you will be right. But most traders, let's be honest, buying the dip sounds good until you're in the dip. And next thing it goes lower and lower and lower. And you go from, I'll be all right, it'll bounce, to, oh my God, my capital is depleting. What do I do? Always remember, guys, and this is why technical analysis, that market's not trying to trick you. Right? Market's not trying to trick you. If the market's telling you it's a sell signal, it's a sell signal. Okay? So always remember, your ability to stay solvent versus you being right are two different conversations. So again, and tattoo this on your forehead, under no circumstances do you buy a stock below the 50-day moving average. All you need to do is wait for it to get back above the 50-day, because look what happens on the Qs once it got back above the 50-day, right? We started a macro rally from 462 all the way, right? All the way to 536, okay? So under, bearish, over bullish. Part two, right? This is part two. This is the most basic stuff, guys. This has nothing to do with the PS60 theory. It's the most basic stuff of technical analysis. Under no circumstances, okay, do you buy a dip if a stock hasn't broken out yet? Okay, I'll repeat. Under no circumstances do you buy a dip on the stock, even if it's above the 50-day moving average, that it hasn't broken out with. And the reason why I say that, theoretically, we know the stock is above the 50-day, and that's bullish. But there's no guarantee that it'll get back above the top of the channel, right? Think about that. It might take weeks. It might take months. Well, hell, what happens if it loses back the 50-day moving average? And then you get a clear sell signal. So under no circumstances do you buy a stock, you buy the dip on a stock, right? Until the stock breaks out. So here's an example. Here's a real-time example. I love using Tesla as an example because there's so many layers to this symbol. And this is why the stock is such a great trading stock. So the stock has been stuck in this range for the last week and a half. Let's just call it 2 weeks. And somebody can turn around and go, well, the stock was at 335 2 weeks ago, Dan. Now the stock's at 322. I want to buy the dip. We're in a bull market. It's above the 50-day moving average. I want to buy the dip. Okay. Let's just say you bought the dip, right? You bought the dip. Doesn't matter what price. Stock was at 335. Let's just say you bought it at 325. 10 points off its highs. Theoretically, you are right, right? Theoretically, you are right. It's above the 50-day moving average, right? There's still option flow in the market, although kind of silly, but option flow in the market. Everything seems to be good. Here's the problem, right? Here's the problem. Is there a guarantee that Tesla will reclaim back the 20-day moving average? Because remember, wasn't Tesla the last stock to get back above the 50-day moving average? Do you guys remember when the market was going nuts when the keys reclaimed back the 50-day moving average and everything was rallying and we're like, why isn't this damn thing can get back above 295? It took weeks and weeks and weeks and weeks, and there's no guarantees. So the idea that you bought the dip because it was $10 higher only two weeks ago, theoretically you are correct. But now, right? But now we have war headlines. By now, you got put buyers coming in. By now, if there's enough fear, you're going to retest back the 50-day moving average. So you didn't buy the dip $10 ago. Now you're in the middle of a downward spiral and you're hoping to God that you stay above the 50-day moving average, right? So if it gets back to the 50-day moving average, you're already down 22 points in the trade. Now you could turn around and lie to yourself and say, hey, it'll be all right, right? It'll be all right. But what happens if it doesn't, right? What happens if it doesn't? So you took a situation that was completely in control. All you had to do was wait for it to get back above the channel, but instead you bought the dip on a stock that hasn't broken out yet because the daily chart says the stock is below the 20-day supply. And that's the whole point of the 335 area. So now what do? Where's your out? There's a big difference between belief that your stock will be okay and having conviction versus the chart telling you, not so much. What do you do at 303? Right? What do you do on that first close below 303? You can't say, I hope it comes back. The market's telling you, we just lost the 50-day moving average. The market's telling you the recent lows, right? The recent lows were around 280. Can you sit in the stock to 280? Or are you starting to get nervous? Right? Is it too much for you? Have you made a poor choice based on what we discuss now in nauseam of thinking, of guessing, anticipating? Right? So all these things could be avoided, folks. Okay? All these things could be avoided. Below the 50-day, you never, under any circumstances, belong, let alone take a bounce. And under no circumstances do you buy a dip of a stock that is still below daily supply. And as you can see here, we are still below daily supply. Okay, everybody got that, guys? Pretty basic stuff. Like this is not, I'm not breaking, I'm not breaking any news here. This is pretty basic stuff here. Now the question is, how do you buy the dip, right? How do you take advantage of a hot stock that's just resting, right, guys? Think about that. And we're going to talk about daily examples, and we're going to talk about intraday examples. And it's very, very important. So at least we got the basics out of the way. Above the 50, good. Below the 50, bad. No chance in hell you're buying a stock that hasn't cleared out supply yet. So you never do that. It's like the theory of, would you ever buy, guys, put a one in the channel. Would you guys ever buy a dip on a stock that had a double top? Think about it. Right? Why would anybody buy a dip on a stock that had a double top? That's exactly what this is. Think about it. Think about it in a way of, you're buying a stock that put in a double top on a dip. There's no guarantees, right? Like, look how many times Tesla's been rejected off the supply. Forget about the 20-day. Look how many times it's been rejected off the 150-day. Once, twice, 3 times, 4 times. So my point is, how many times can you continue to buy the dip on a stock that's getting rejected at supply until it loses the bottom of the range? And now you took a paper cut and you turned it into a severed head. So we don't want to do that. So now we want to talk about stocks that we can buy, right? We can buy dips on. When to buy dips on, right? When to buy dips on. When you should be buying dips, and when you shouldn't, what we just talked about now. So let's use a stock that recently has broken out, right? So let's use Oracle. So keep this in mind. Oracle didn't break out here, guys. Okay? Oracle didn't yeah, there's a million examples. This stock market has been pretty good, right? Oracle did not break out here. This is one big continuation. Although I had a great, pretty good trade on Oracle above that 205 level last week, but that's not here nor there. So Oracle came out of this channel, right? Came out of this channel right over here, right, guys? Came out of this channel of this 150-day moving average. Again, obviously, it gapped above the 50 and came out of this channel, but we're going to use like the most recent channel. So Oracle got above this channel here, and this channel was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days, right? So 12 days is roughly what? 2.5 weeks? Because each week is what, 5 days? So we have 2.5 weeks, right? And you saw it put in a high. It put in a high of 34.32. The next day, it was profit taking, right? The next day, it was profit taking. You can see by that red candle. And all profit taking is profit taking. It doesn't mean the dynamics of the stock have changed. It doesn't mean that the trajectory of the stock has changed. All it means is the stock needs a rest, because by the time it broke out, the stock already went from 154 all the way up to 164 in 3 days. So the stock needs a rest. Now the question is, does the stock rest for 1 day, 2 days, 3 days? Ideally, for the next leg up, the higher probability you want more consolidation, the better. But when there's a runaway train, there is a runaway train. So the first theory of bouncing something, always remember, I don't care how good the 60-minute chart looks like. I don't care how good the 5-minute chart looks like. It all boils down to the daily chart. Okay? So the daily chart is king. Always remember, guys, before we enter on the 60-minute channel and see there's more supply or demand zone on the 5, we need to have a daily, right? We need to have a daily confirmation. So if you see here, the next day there was a red candle. It hit its line. Let's just call it hit its line. What line was this? Doesn't matter, right? It hit its line. Now, why did it hit its line, right? Supply turns into demand, right? Think about it. When a stock breaks out, that supply that it had to get above is now demand. So if it's a true breakout and it's a true res day, the first order of business is you have to identify where its daily support, its daily rising support will be. Okay. In this case, and you can see this red candle, right? Followed by the breakout of the stock. It stopped right on the orange line, and it stopped right on, what line was this? 61, the 200, right? So you had two supply zones that turned into a demand zone, right? You had the 5-day moving average and you had the 200-day moving average. And it was very important that it took out the 200. That's what started its trajectory. So if you notice the low of the day, right? And again, it's not going to be perfect. Guys, we all know stocks overshoot, right? They overshoot their level. Because remember, it's a moving average. It's not a concrete wall. So if the support is 157.48, it still could, it could overshoot it and trade to like 146.50. That's why we use the word remount, right? We'll talk about that in a second. I don't want to confuse the new people. So it could overshoot it, because always remember, these are moving averages. So if one day the high was 10, the next day the high was 9, the following day the high was 13, it's a moving average. So it doesn't have to stop there. A lot of times, to our amazement, it actually does stop to the penny. But a lot of times it overshoots. Just because, again, it could be how thick or thin the stock trades. The thicker the stock, like a Tesla, Nvidia, Apple, they're a higher probability that they will stop in that general area. If you're trading like a Meta, a Microsoft, a CRWV, a Circle, right? There's a chance it'll overshoot it. That's where the remount comes in. We'll talk about that in a second, right? So what you want to do is, number one, identify on the daily chart, and the first order of business will be the 5-day. The 5-day is the shortest term sentiment. That means the 5-day moving average will probably act as his first measure of support. And that's where this orange line is. You see this orange line, guys? Right? You see how it keeps on bouncing off this orange line on the trajectory? Bounce, bounce, bounce. Here it overshot a little bit, but bounce, right? Here, look. Orange line, bounce, orange line, bounce. Everybody see it? Orange line, bounce, right? So that orange line is the 5-day. So on the day that there's profit taking after a breakout, you want to identify the next day where the orange line is, because that's the highest probability where it's going to bounce. Everybody see it, guys? Guys, everybody see it? How many times it bounced off the orange line? Bounce, 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 right? Bounce, bounce, bounce. Everybody see that, guys? Because again, the first thing for technical analysis, you have to see it. You have to visually understand it. So if you visually see it and go, oh crap, I get it. It's bounced, right? Okay, I get it. Okay, now I understand why the 5-day is important, right? I understand why the 5-day is important, because that is your first line of defense. It's the complete opposite, right? It's the complete opposite of when the stock breaks down, right? So the stock broke down below the 50-day moving average. It rallied to the orange line. What happens? Everybody see that? What happens when it hit the orange line after it broke down? Rejected. Hits the orange line. 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 Rejected. 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 Right? So you get the point, right? Remember, it's the 5-day. It's not supposed to be set in stone. Again, the 5-day could be reclaimed and lost in the same day. We've seen that a million times, but at least it's giving you a point of reference, and that's the name of the game. So the first thing you want to look for when a stock breaks out is the next day. If there is weakness, you want to identify what the daily chart of the 5-day moving average is. Everybody got it, guys? That's your first area, right? That's your first area that you want to take a daily bounce, because the daily chart is telling you that the stock broke out the previous day. There's some profit taking at the open. And now it's your ability, and now it's your job to figure out, where can I find the safest entry possible of a stock that just broke out 12 hours earlier, that I could get the same value and pay a cheaper price. So always write this down, guys. The 5-day moving average is the highest probability the day after a stock breaks out. Okay, guys? That should be the most basic thing of taking bounces. Okay, the most basic thing. And the opposite is true as well. If a stock breaks down the previous day and the next day it gaps up, it's probably going to get rejected at the 5-day supply. So breakout first day, next day profit taking, you buy on the 5-day. The stock breaks down on the daily chart, the next day gaps up into the 5-day, and you want to short it into the 5-day moving average. So that's the most basic way of attacking a strong stock that's broken out or a weak stock that's broken down. You could see that by these examples of just Oracle in itself, right? It's a very, very basic thing. Now, keep this in mind. Keep this in mind. There's only one breakout for a stock, right? There's only one breakout. Everything else is consolidation. Everything else is continuation. So the further a stock goes away from its breakout level, the higher probability that the stock will get pulled at any point, okay? Because this is something that's called gravity. Gravity is real. You know, if a stock goes from 160 to 205, it doesn't need a reason why it's going down. You follow what I'm saying, guys? You don't need a reason. It's like somebody turns around eventually on this circle, because eventually circle will be down 50, 60 points in one day. And somebody, you know, I can understand buying the stock here, 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 on the bounce. You see where it bounced, by the way? Kind of proves my point. Guys, you see where it bounced on June the 17th? You see where it bounced on June the 18th on this orange line, right? So when you have an uptrending stock that breaks out, you always want to test a long, right? You always want to test a long on the same strong stock into the rising orange line or the 5-day support, okay? But eventually, somebody's long here, and eventually somebody's long here, and eventually the stock will be back to like 150. And they're like, is there any news? Yeah, the news is you bought it on the 35th floor, right? You bought it on the 35th floor. Well, yeah, I mean, CRWV is the same thing. And that's my point about Tesla, right? That's the point about Tesla here, right? Here you're buying stock on the first floor when it breaks out above 335.50, right? Here's where you're buying the stock on the first floor, right? Above 295. So if you're wrong, you know, you get a couple of bumps and bruises. If you're buying it up here, and you're buying it up here, and you're buying it up here, well, yeah, this is what could happen after, right? Because the further you go away from the breakout, the higher probability they're going to kill you, right? They're going to kill you. So here's kind of where the dynamics change a little bit, right? So Oracle has been on a really, really big run, right? And it's been bouncing off the 5-day moving average. But now we got jitters, man. We got jitters. We got the tariffs, which will probably go to the back pages now. We got tariffs. Now we are active participants in this conflict. And now the stock is 50 points above its breakout level. Well, the stocks that get pulled the hardest are the stocks that, you know, they're up 50 points above their breakout level. So as much as the 5-day moving average is still support, it's not solid support like it would be on its first day above a breakout, on its second day, on its fourth day. Now you're having a conversation is Oracle broke out 3 weeks ago, right? How aggressive do you really want to try to bounce it on the 5-day? Maybe it works, maybe it doesn't, but how aggressive do you really want to bounce it on the 5-day, right? Compared to a stock that's just broken out day 1, day 2, right? So always remember, guys, the farther a stock breaks out, the less opportunity that the intermediate or short-term support will hold just because of gravity, right? Just because of gravity. So the highest probability of bounces are day 2, day 3, day 5, right? But not day 15, not day 27, and not day 42. Because again, you get any type of gassing out by the buyers, and that 5-day, right? What happens? That 5-day is lost. But just to kind of prove the point of how stocks trade from supply to supply and demand to demand, right? It lost its 5-day on Friday, but look where it stopped. Guys, you see that? Look where it stopped. It stopped on its next supplies, on its next demand zone. Now, what happens on Monday if it loses 204? Right? Can anybody tell me where the next area for potential where the stock can go to? Right? This thing has room all the way down to 195. Yeah, 95, 97. So that's my point. You can't just randomly buy dips. You better know how much room there is to your next demand zone, or you're fried, right? You're absolutely fried. So the moral of the story here is not all dips are the same, right? Not all dips are the same. We definitely don't want to buy them underneath supply. We definitely don't want to buy them under breakout levels until a stock broke out. And we sure don't want to buy them 3 weeks after the stock broke out. So you kind of want to leave those stocks alone. Okay. I say this all the time. Can you test levels? Absolutely. I test levels all the time, right? I forgot what day it was. It was Monday or Tuesday. I initially bought the dip on Tesla. I saw it was a heavy bounce. I sold it, right? I sold it break even. And then we caught 2 shorts on it, right? We caught a natural pivot for like $3, and we caught a rejection for like $1 and change. So you're allowed to shift gears, right? You're allowed to shift gears. But the point is, when a stock is trading this far away, right? This far away from its daily channel, there is a higher probability that you will get your knees cut out underneath you. So the tighter the stock is, the higher probability that it will bounce. The further that it is from its breakout level, the higher probability that you will have to be exposed, right? You will be exposed, and there's a higher probability the stock will get pulled. So always remember, guys, do not buy dips when a stock is 2 weeks away from its breakout level, because you will get hit. Well, yeah, I mean, if you see option flow coming into weakness, if they're coming in for out of the money calls as it's approaching support, yeah, sure. Absolutely. You could test it out. Oh, because Devontae, keep in mind, what's the worst case scenario? The stock is heavy, you lose 30, 40 cents, 50 cents. Who cares? Right? Who cares? So again, I always encourage to test out a level, right? I always encourage to test out a level, but be conscious though, be really conscious. The further you are, the higher probability it will get pulled, right? Yeah, it will get pulled as well. So now the question is, right? Well, now that we know a stock is strong, how do we buy it intraday, right? The stock is breaking out. How do we buy it intraday, right? Isn't that what we do, right? If you want to avoid, paying strength into the stock, now the question is, well, how can we take advantage of it? How can we take advantage of a stock that is in a massive daily uptrend, is just confirmed, and they're just buying the stock every single dip? Well, there's an answer to that as well. So let's use CRWV, right? Let's use CRWV. Now, keep this in mind, right? Now that we established the stock is strong, and you can see here, again, you can see with your own eyes, every single time it hits the orange line, what happens, right? Bounce, bounce. So now we are on a stock that is obviously very, very strong, right? It's very, very strong. I traded it twice on Friday. I know a lot of you guys traded it twice on Friday as well. First trade was like 2 and change, and the second one was 5. It was damn near 5 points. So if you guys remember, okay, and again, this gets a little bit more dicey, a little bit more mentally draining on the intraday bounce versus the daily bounce, because you have a lot of moving parts on the intraday bounce versus only one area that you could bounce on the day, right? So if a stock broke out at 65 and it retraces the next day to 62.5, and that's the 5-day, you want to bounce it off to 62.5. During the day, a stock like CRWV, number one, we saw Friday, 185 weeklies when the stock was at like at $78. 185 weeklies. We saw for this week 200s. So the options market's there. The key is not to chase this thing, right? The key is to buy this thing on bounces. So because the stock is thinner, always remember, guys, because the stock is thinner, there's going to be more volatility. What I mean thinner is, even though the stock traded, how many shares on Friday? traded 31 million shares. 31 million shares seems like a lot. It's really not. Versus NVIDIA, who traded 242 million shares, right? So you know it's harder for NVIDIA to go up 50 cents or go down 50 cents than CRWV to go up or down $5, right? Because if you guys remember, my first trade on CRWV, I don't even remember what price. What was it? Do you guys remember the first? I remember the second trade I took was 181. Do you guys remember the first one? Was it also 181? I think it was 181 also, the first one. Anyway, or was it 180? I can't remember. Anyway, the point is it only went up a couple of points. 80, thank you. The first time we got long, the stock went up 2 points. We made some sales up 2, break even on the balance. And if you guys remember, the stock went down 6, right? The stock went down 6. So it's not like, it's going to trade in a 50-cent channel like NVIDIA. So when you get to these 60-minute channels, you have to identify, right? You have to identify the highest probability where a stock could potentially bounce. So here's kind of the general thing that I look for, right? I would always prefer the 60-minute bounce, right? I would prefer the 60-minute bounce. The reason why I prefer the 60-minute bounce, it gives you pretty much a bigger dynamic. Because remember, every candle is 1 hour long. There's only 6 candles through the day. So it's not like you're trading on a 1-minute chart. So you have 6 hours worth of data, or at least throughout the day. So every 60-minute demand zone is pretty clean, right? It's pretty clean and pretty identifiable. That's even a real word, right? And you can see here, if you just like kind of zoom out, you can see here the majority of time where the stock held its form, right? It's when it's got down to the bottom of the channel, usually that red line, which I believe is the 34 period, right? But here's kind of how I look for it, because again, you're not going to get that perfect entry. And this is what we talk about remounts. And I'll get to that in a second, right? If you look at the general area where the stock has bounced from, you'll notice that multiple demand zones are kind of commingling. You guys see that? They're kind of next to each other, right? They're kind of next to each other. So like 184 is an area that there's a lot of demand zones. And then you got this pretty clear demand zone where it kept on bouncing off the red line. You saw pretty much so many reference points here, once, twice, 3 times. But for a thinner name, I prefer to do it off the 60-minute chart, just because you're risking the idea of that there is a major pull. You could avoid yourself $2, $3, $4. Now, again, if you're trading very conservatively, your max pain in something like this should be only $2, right? Some of you guys only trade for $1, but something like this, you need at least a couple of dollars, just because how thin it's trading. So if you guys remember the bounce, right? The bounce play or the remount on Friday that I took was off that 181. Do you guys remember? We talked about it. There's 2 areas, 181, 182. You guys remember that? That's kind of where this whole orange and green line were. You guys remember that? There's like that orange and green line were. So it was between like 182. Yeah, it was like 182 and 181, right? So like you have your point of reference there. And I've always said, do not put your bids in there because it's so thin, unlike a stock like Tesla or NVIDIA that, it's so thick that even if you're wrong, it could sit there in the 20, 30 cent range. And if you're wrong, you could just lose 20, 30 cents. But when you have a stock like this that can literally come in for dollars, right? You want to identify the area and just watch that area. So for example, I was watching first 82, right? It went through 82 pretty easily. And then I watched 81. So in 81, it was just sitting there, 80 and a half, 80, 50, 81. And it just kind of stabilized. If you guys remember, it stabilized around that 81 level for like 10 minutes, right? So I knew My worst case scenario was the low of this candle, right? Which was the low, which was the low, what was it, 180? Oh, here, was the low of this candle here, right? So the low of this candle was 80. Even though the bounce spots were 181 and 182, it got down to 180. That's the whole point. It got down to 180. That's why I kept on saying ahead of time, don't put your bids in there because they could pull it for $4 or $5. Instead, watch those areas. And if the stock stops going down and stabilizes, when it remounts, right? The word remount is like getting on a horse. Visualize yourself getting on a horse, right? You take one step, you put one foot into the holster, and then you pull yourself onto the seat, correct? So all a remount is, picture the orange line or any line as a horse. So sometimes it goes through, that's when you're standing on your feet, right? And when it gets back above the orange line or gets back above the horse, that's called the remount, right? Called the remount. So I got long, I was just watching it, 80.5, 81, 80.5, 81. And all of a sudden a buyer came in for the 200s for next week. So I bought the 81, right? I bought the 81 because it remounted. You got back on the horse. You got back on the saddle at 81. And that was the go. The fact that it reclaimed back 82, because I think Jerry Smith, he bought the 82 remount. I bought the 81, but both of them were right. I mean, because those are the two areas we were looking for a bounce. So regardless if you bought the 81 remount or 82 remount, it gave us a move right to 86, which turned out to be the high for the afternoon. I missed the 86 sale by a few pennies, whatever. I know some of you guys got it. So instead, I got down to 10%, like in the 85.40s, and ultimately I got stopped out of on the rest, break even. But the point is, to do a successful remount, the first order of business is you identify the daily to see how strong the stock is on the daily. And then you are switching to the 60-minute to identifying where potentially a rest can come to a strong stock that's been very, very powerful all day. Now, this part of the webinar is where I turn to you guys who've never seen this before and go, you're not going to understand the finished version of what I'm saying. You have to see it in real time. So tomorrow, it's going to be a lot more clearer on the bounces and the rejections because you're going to see the price action. It's tough to talk about it because you have to see how the stock trades to get to that level. That's the one aspect of today's webinar that you have to see play out live. That's why I wanted everybody to come into the webinar before the workshop to see it play first, and then you break it down after hours. I believe, Boris, you bought the 81 remount with me, correct? I believe, yeah. So Boris bought their 81 remount with me, and it gave us a $5 move, right? It gave us a $5 move in the afternoon, which is pretty cool. But right now, me trying to explain to you that you didn't see it on Friday, it's very confusing, right, guys? I'm confused and I'm talking about it, and I know the levels we bought it. So it's very, very important when you're talking about a stock that's retracing, okay? It's very, very important to understand where it is in the daily channel, okay? And your first test is always the rising orange line, okay? It's always the rising orange line, then it's the rising green line, and then it's this brown diarrhea substance is what would be the next line of support, and on and on and on. So you can test levels. You can literally test levels at every single level. Some bounces, and you guys saw the whole week, some bounces, I can get a bounce for 50 cents, and that's a heavy bounce, obviously. Or we could get a bounce for $5, what we saw on CRWV. But don't be afraid to test levels. Because again, when you're testing a level on a potential bounce or a remount, it's the same thing. I just interchangeably change those words. Don't be afraid to test the level, because if you're testing that level with quarter or third size anyway. So if you're trading, for example, 100 share lots and your quarter size is 25 shares, at worst case, you lose $25. You follow what I'm saying? But the way we play bounces and the way we play rejections, if the stock is heavy, majority of these trades wind up as break-even trades. Right, guys? Majority of my balances are break-even trades. If they're heavy and they stall out, they're break-even trades. So in a sense, you're not even risking money on these trades, just because, again, this is how important these levels are. So again, sometimes the balances I take will be 50 cents. Some balances I'll take will be $5. But again, don't be afraid to test out these levels. Obviously, watch the futures. If the market's puking, the last thing you want to do is buy dips. But if the normal trajectory of the day is very organic, very calm, then don't be afraid to test out a level. Same thing on the short side, right? Let's use Tesla as an example. Same thing as on the short side. Okay? Same thing on the short side. So let's go to the reason why I want to bring up June the 17th. This is the cleanest I could remember of Tesla being rejected on the 60-minute channels. If you guys remember, I think it was Devontae, I know a lot of you guys did, but right before I left at 2 o'clock, Tesla got rejected for like $5, $6. Okay? So if the opposite is true, right? If the opposite is true, let's make this bet, let's make this bigger, right? If the opposite is true, right? If Tesla's bouncing off the orange line, right? Tesla bounce, Tesla bounce, Tesla bounce, Tesla bounce. Everybody see it? Off the orange line? Tesla bounce, 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 right? If it's going to bounce off the orange line, isn't that where we want to reject it? Right, guys? Isn't that where we want to reject it as well? So if the stock is breaking down, right? If the stock is breaking down, check this out, right? Look at this. It trades back up to the orange line, rejected. It trades back up to the orange line, rejected. It trades back to the orange line, rejected. It trades back to the orange line, rejected. And this is the one that Devontae got, and I know a lot of you guys got it as well. That last rejection was worth $5, right? So your first order of business, if the stock is weak, you want to reject it off the declining 60-minute. Guys, we're talking about the 60-minute, okay? You want to reject it off the 60-minute chart, okay? If it's strong, my God, my voice is shot. When it's strong, you want to buy it off the orange line. Now, here's the question, right? Here's the question. I know some of you guys have this question because it's a very obvious question. Well, Dan, sometimes it's going to go through. What's our stop, right? There's two answers to that, okay? There's two answers to that. For the experienced trader, you want to use the previous candle high as an out. So, for example, right, if you took the rejection here, right, if you took the rejection here, your out for the experienced trader is the previous 60-minute high. So the previous 60-minute high was 323, and you're rejecting it at 320.5, 2.5 points, right? That's 2.5 points. If you're rejecting, if you're rejecting it here, it's obviously a bigger thing. How I usually do it is, I personally don't look at the previous 60-minute high. I could tell right away in the first 40 seconds if the stock is a heavy rejection or a good rejection. If the stock gets rejected just the same way as the stock has a bounce, it's going to give you price action in the first 30, 40 seconds. Right, guys? Usually, instantly, it's going to give us 50 cents, 70 cents, $1. Instantly. That first 45 seconds, it's going to instantly give us 50 cents, $1. Instantly. If the stock is just sitting there and sitting there and sitting there and sitting there, there's a higher probability the buyers are getting stronger. So I would generally use like 50 cent stop. And that's it. If you guys remember on Wednesday, I took a bounce, I lost 40 cents, and I took a rejection that I lost 60 cents. You guys remember that? Previous days, I made $4.50 on it, but that's the point. You lose pennies, guys, you lose pennies and make dollars. Everything that is the whole point of the PS60 theory. You're risking pennies on these areas, right? You're risking pennies and you're making dollars. You're risking pennies and you're making dollars. I would take 100 trades in a row losing pennies. And I'd also take 100 trades in a row making dollars. And that's the mindset, right? Because when you're taking a bounce, you're going against the trend, right? Think about it. When you're taking a rejection, you're going against the trend. So you have to decipher in the first 45 seconds, once you're into that trade, once you're in that rejection area, it should get rejected right away. I mean, right away. You should get 50, 60 cents out of it instantly in the first 20 seconds. If the stock doesn't go down and it's just sitting there, right? So say, for example, you shorted the stock 325.50 and the stock is sitting there 325.30, 325.60, 325.40, 325.70. Like, right? What does that tell you? That tells you is the buyers are stabilizing, okay? So you have a choice. You could either get out, use break even as you stop, which you can't, right? And again, I've been saying this for years. If you're really dialed in, right? If you're really dived in, I mean, really dived in, how all your trades are going to end is either really good or flat, right? And when I mean flat, losing 40 cents on Tesla is a flat trade, guys. If you're trading, think about it. If you're trading bounces a quarter and third size, right? Let's just say you trade 100 share lots. That's your quarter size, third size. And you just lost $40 on 100 share lots. That's lunch. That's lunch for two people, guys. So when I mean flat trades, it could be, I could have a trade that I reject Tesla. It goes down 50, 60 cents. I take some off and it stops me out break even on the balance. For me, that's a flat trade. That's a flat trade. So it doesn't make a difference to me if I make 40 cents or I lose 40 cents. It's a flat trade. Now, if that bounce turns into $2, $3, $4, $5, $6, $10, $15, it's a phenomenal bounce. So always remember, right? Always remember, don't be afraid, right? Don't be afraid. Losing money is part of the game, but losing money technically is necessary. You have to know how to lose money technically. So if the stock is heavy on a bounce, you get out of it, right? If you guys remember on Tuesday, I took the bounce on Tesla, and what happened? Tesla only went up like 50 cents. So I sold it break even, right? I sold it break even, and the stock collapsed $4 from there. And then what happened transpired next. I took the rejection off the first bounce, and it worked for $1 and change. And then later in the day, we took the natural pivot and went down another $3. So don't be afraid, folks, that testing levels is confirming to you where the next potential move for the stock can be. Okay. So if this initially what you want to do, especially as a new trader, as soon as you get cash flow off that move, 50 cents, $1, take some off, right? Take some off. And then automatically go to break even as you stop. The great part about attending the webinar, if we're in the bounce, you're going to hear me. Guys, I talk 6 hours a day. I talk through every single trade. So if we're in a bounce, let's say at 325, and it goes 325.30, 325.50, you're going to hear me say right away, guys, it's heavy. It's heavy. It's heavy. Use break even as you stop. It's heavy, right? So there's no guessing. So the moral of the story is, folks, what we do is very neat, is very, very cool. Nobody trades the way we do. Okay. Nobody trades the way we do. We've had absolute incredible turns around in people's careers. People taking, irrelevant money and turning into ridiculous amounts of money. I mean, Brawley again. Look at Brawley. Latest example, just took from $2,500 to $200,000. That's insane. That doesn't even make sense to me, right? Doesn't even make sense to me. There's people putting in 6-7 figure years, and everybody starts exactly the same year. And all we ask is, if you're serious about this, you have to allocate a year out of your life to fully understand all the dynamics of this, right? There's a lot of moving parts. Guys, I can feed you pivots till you're blue in the face. I mean, literally to the blue in the face. And you're going to make money because the process works really, really well. But until you fully understand the dynamics, the moving parts, and there's a lot of moving parts, right? You're cheating your development. You're cheating yourself because, again, if I decide not to trade one day, right? Like there's days, you guys know, there's days that I could have an overnight and I'm up at 4 o'clock in the morning and I can't function. You know, I give you guys pivots till you blue in the face the next day, but I can't function. What are you going to do? Not trade? Right? Think about it. What are you going to do? Not trade? You're gonna not trade because I'm exhausted for the day, right? The reason why so many of you guys do really, really well is because you believe in the process. Nobody needs to hold your hand. That's the whole point. Doesn't matter if I'm in the trade. You think PACS cared, right? You think PACS cared if I was in the trade or not? I wasn't in the trade. I had nothing to do with it, right? I had nothing to do with PACS. PACS went from 1240 to 14, 12 hours. I didn't buy DraftKings, right? I didn't buy DraftKings. I had nothing to do with DraftKings. All you guys were long DraftKings at 39, went to 41 in 2 days, right? Trust the process. Folks, not everything is for everybody. That's why a lot of times, you'll see these crazy stocks. I won't trade them. And they'll work really well. And for me, I just don't care about them, right? That's the key, guys. The most important part of trading before you figure out, you got to figure out, number one, what is my account size? What's my pain threshold? What's my risk tolerance? What's my monthly expenses, right? What kind of trader do I want to be? Do I want to trade Tesla? Do I want to trade small caps? Which if you trade small caps, you're done before you even started. Your career is on tilt before you even started. But whatever, to each his own, right? For the 4 people that could trade small caps on social media. Anyway, I won't judge. Mostly. Anyway, but you guys know it's true, right? You guys know it's true. But before all jokes aside, and Kenyon, edit that last part out. I don't want to be that guy. Anyway, no, but the most important part, guys, before you can figure out what you want to be in this business, you got to figure out all these different things. And everybody's built differently. Everybody has different mental makeup, account size. And the key is you want to be confident in trust what you do best, not what I do best. I'm very good at trading beta. I suck at trading everything else. Okay, not suck, but I'm not as good, right? I'm very, very good at trading technology. I'm not as great because it's random. Because the more random stock you trade, the higher probability you're trading it with all retail. So always remember this, guys, and this is a big light bulb moment, right? This is why our process is incredibly unique. If you believe in the theory that 90% of traders lose money, which I believe 99% of the traders lose money, by the way, because once your first 3 years you're make it or break it in this business, and without information, you're gonna bow out ungracefully. So if I believe that 99% of the traders lose money in their first 3 years, why would you want to trade like them? Just think about that, guys. Just think about that from a common sense point of view. If everybody's looking at the same stock at the same time on the same time frame and they lose 99% of the time, why do you want to trade like them? It's kind of a mic drop if you think about it, right? It's like you don't even have to answer that question. You know I'm right, right? Like I'm right. I mean, just think about this. If majority of you guys in one way or another would have never come here in the first place if trading like everybody else does, right? Think about it, guys. It's not anything I'm breaking news. But if trading like everybody else was a good thing, you would never come here in the first place. Right? Think about it. Makes all the sense in the world. So we have a very, very unique way of approaching the market. It's a break away from the normal, right? It's the break away from the normal. And it is really good. It's really, really good. And it's not just me saying it. Guys, I encourage all you guys to speak to each other, whether it's throughout the day, email each other, anyway, just really speak to each other. Of course, you're going to have people that just don't get it yet, man. It's just so normal. Guys, it took me 10 to 12 years to get to the mental mindset of where I am now. I'm on year 26. Do you honestly think everything is going to automatically click in your first 2-3 years without any guidance, without any information, without any process? It's impossible. A guy like me and a guy like all my friends, right? And a lot of my friends, you can Google, right? We're going to take your lunch money every single time. Even if you beat us once, you cannot beat us. That's the point. Because once it finally clicks, and that click could be 3 years, 4 years, 5 years, or a schmuck like me, 10 to 12 years. But once it finally clicks, it's magical, man. It's absolutely magical, because then nobody could take it away from you. Nobody. That's the most powerful thing, is to be in control of your trading. And you realize that you don't need to trade every single day. You don't need to trade every single symbol. You don't need to trade every single stock that's moving. You don't care about the hot stock. Guys, we don't trade the hot stock of the day. We trade the stock that technically confirms that turns hot. By the time these schmucks realize what's going on, we're selling to them. Oh my God, Tesla's up $37. I got to go long. Okay. How much stock do you want to buy from me? Okay, cool. Right? So it's very, very important. So what we'll do, guys, for the next 10 minutes, because again, my voice is shot. We're doing this now for 3 hours. Any questions on bounces, rejections? Because everything else we go through the webinar throughout the day, Monday through Friday, every single day. We literally go through everything. So if you have specific questions on bounces, on rejections, let's open it up. And then if not, I'll see you guys all tomorrow. Yeah, Rich, that's the first after its initial breakout. Rich, after the initial breakout for the stock, well, let's just say you missed the initial breakout for the stock, the first dip into the rising 5-minute support is very valuable, because you're taking advantage on the first breakout. But throughout the day, you want to get a bounce to the 60-minute. Okay? Yeah, Rahul, that's basically what I just talked about. You want to use the 5-minute, like Stoic uses the 5-minute more than I do. Like, that's just the trend for the stock. So if you look at any stock like CRWV, right? Let's use CRWV from Friday, just because it's from Friday, right? CRWV, right? So let's use the 5-minute. So you'll notice when the stock broke out, right? When the stock broke out, every time it hit the orange line, right, on its opening range high, when it hit the orange line, what happened? It bounced, bounce. So you could play the orange line on the 5-minute after the stock initially breaks out above the previous day's highs, right? So you can use the 5. You see that? All right, buddy. Have a great weekend, Boris. So you can use the 5. So once the stock breaks out above the previous day's high, you can use the 5. But the problem with the 5 is, right? The 5, Kenya's got another video that we go a little more extensively into it. The problem with the 5 is, especially on the thinner stock, eventually it will test the 60. And that's where I did the remount. And that's where I kind of did the remount on Friday. I always prefer the 60, right? But if I miss the initial push on a stock breaking out, I will test it on the first 5-minute bounce. I will test on the first 5-minute bounce. Kenyon, if you can get an interview with these guys, would be great. That's just not my, Kenyon would take care of all that. If Brawley, I don't know what happened to Crizzle. I don't even know if he's still here. He's a lifetime member. And for all you guys who don't know, Crizzle took a $500,000. He took a $500 account and turned it into $100,000. Like really, really quickly. Which is absolutely insane. He kept on, and you're going to ask how he did it. We were in a very hot market, and he kept on basically, and I wouldn't recommend this to anybody, but he kept on going all in on his $500 account, but he kept on going all in on macro setups. So he would catch like a $30 move on Tesla. The next week, he would catch like a $30 move on Meta, just because the market was so hot, right? He would catch a $5 so his option account kept on doubling and doubling and doubling and doubling, and then ultimately he took $500 and turned to $100,000. So then he bought the lifetime membership, right? He bought the lifetime membership literally in a month. And then I don't know what happened to him. Right? So I'm hoping he didn't do the opposite of kept on doubling in a not hot market. Yeah. But so what he did was very freakish versus Brawley. And I can't speak for Brawley, but he would let you know, versus Brawley that took 2,500 bucks and turned into 200 grand. What he kept on doing is just kind of slow and steady, right? Kept on slow and steady, taking decent shots on the macro trades, but he would be very slow and steady. So that would be kind of the way I would recommend it. But the point is, if you can allocate a year to your life and mean really putting the PS60 theory to work, you're going to be shocked where you are a year from now. I'm telling you, all you guys know Matt and Larry. Guys, Matt Whitaker, and I don't want to speak for him, Matt Whitaker sold his truck for $12,000 to start trading. The guy has 6 cars, including a McLaren. Larry did pretty much the same thing. Again, it's not typical, but it's possible, right? That's the whole point. It's not typical, but it's possible. And that's the point. You know, these guys have been with me now for years, right? And the key is, if you just adopt the theory that, hey, you don't need to trade every day. You just don't. And you wait for those big premium days. Because I can tell you right now, without even speaking to them, I speak to Matt and Larry every single day. I am not going to have any question to know that Matt is going to be long 500 calls on Tesla above 336. I have no doubt in my mind. Maybe 300, maybe I don't know, 500, maybe it's still a little too much, right? And Larry's the same. So that's how you get your account really going, and everything else you want to, again, assuming you want to trade every day, because tomorrow we could have a day, and I'm warning you guys right now, depending how the market plays out overnight with the futures, we could come in tomorrow and have a lot of value, or we could come in tomorrow and be like, yo, market's down like 4%. Oh, God. What do we do? Should we reject some things? Right. You know what I'm saying? It could be a whole dynamic. So that's my point, especially for new traders. You don't need to trade every single day. You don't want to, borrowing a term from the poker world, you want to play when you have kings, queens, aces. You don't want to play when you have a 2-7 offsuit, right? Guys, that's not a sign of helplessness. That's a sign of maturity, right? I'm not in this business to be right on a trade. I want to make money. We all have kids, right? We all have kids. We all have bills, right? We all have angry poodles that if they don't get fed. So we need to be very, very specific with our money and allocation on our money. And the whole point of the PS60 theory is you want to put you in a situation that you're not trading for today, but you're building your foundation for tomorrow. Guys, have a great, great weekend. Because of you guys now I can't speak. Have a great weekend, everybody. I'm going to go get some exercise. This email will probably go out, right, Kenyon? Probably at some point by Tuesday, Wednesday. All you guys will have it. And yeah, probably about a week. All right, everybody. Have a great, great weekend, everybody. And I will see you guys tomorrow. Okay? Kenyon, I'll call you in 5 minutes after I upload the video. All right, guys. Have a great weekend, everybody. I'll see you guys tomorrow.